more chairs over here, so if you come in, or people come in, we can set up more chairs if you go. Refreshments are down here. And the men's room and such, and the ladies' room, right around this corner. Go out to the right, and the right is on the left. Okay. Other than that, if you could put your cell phones down a little bit so they don't interrupt you, that'd be great. And so we're going to give it another 2 or 3 minutes, okay? But then we'll get going. Let's see. All right, up front, I had a couple of things for you. Now, PIRAC is the overseeing organization in the state that oversees retirement, public retirement. They produce these, or used to produce these, in mass. The last time we had one of these 2 years ago, they gave me like a box of 100 of them. But they didn't have a lot to give them. Okay. So I left one per town. So if your town has one already, please don't take one because I've got an afternoon session for the group 4s, and I don't have any left to give them out, which is fine as long as each town has one anyway. They come in different flavors. They have the regular retirements. Everything's split post and after 2012 when the law changed. And the prior guides include a retirement guide, which is a superannuation regular retirement. Then there's one for the survivor benefits, and there's one for disability. Those are people prior to 2012. That's really what you're concerned with now. Then they also have a couple for the future. They have this is the superannuation, the 20-year retirement after, if you started after 2012. And then they have one for survivors also, people that started after 2012, and a disability. So they have several different colors and different flavors. They're all online if you go to the PIRAC website. So you don't have to have a hard copy. That's why if we just reserve a hard copy for each town, at least there's a reference for people. That's well. And I think you have some.
Oh, we have plenty at my place, but as he said, they are all online. They're on our website. They're on our website or PIRAC's. If you Google PIRAC, I'm not exactly sure. They just changed theirs. It's like PIRAC.state.mass.gov. We are pcr-ma.org. And we have a lot of information. What you're looking at is our homepage, and it's fairly new. We just had it redesigned. We're trying to make it very user-friendly. We're also trying to put a lot of information up there. So we're constantly going to be posting new information up there. Our audit for the people in the towns, I mean, that should be going up Thursday, hopefully, if not Friday, and then you can just pull it from there. But we're going to keep our audits going up there. Our quarterly investment reports, they're going to always be up there to see, a review of our quarterly investments. So we're trying to be as transparent as possible, not just for the membership, but for the public at large.
And just to introduction, David Sullivan is our new executive director of the Plymouth County Retirement Board, which I know we have a couple school department people here, so they really don't go through the Plymouth County Retirement Board unless it's for other than teachers, obviously, staff does.
Well, we have a lot of school members. Yeah. We have the paras, I call God's people, they're doing God's work. All the paras that, very little recognition, not a whole lot of pay, but they do very important jobs. I mean, we have the school custodians, so we have a lot of, school employees that will come into our office. But I just had a quick question. I mean, Charlie was talking.
Let me just
okay.
Introduce Tom. Tom O'Brien is in charge of the chairman of the retirement board for us.
So I'm here to make sure David does a good job.
Yeah. He's responsible for investing all our money, so you can thank him for your check every month. And other than that, any questions for me, and I'll turn it over to these guys.
But a quick question I had is, Charlie was talking about the difference between, the change in law on April 2nd, 2012. Well, there's been actually a lot of changes in law. Depending on when you started, you got grandfathered in to certain rules. The one in April 2nd, 2002 was a major one, which was pension reform, and it was more of a game changer than any other ones. But is anybody here a member after April 2nd, 2012? I can see at least one person. Anyone else? So we have a couple. So I mean, you're paying differently into your retirement. You're still the same rate for most people, which is the 9+2, but you're gonna have to work a little longer because the age factors change. What for somebody like myself is 55, somebody you is 60. For somebody else it's 65, then it becomes 67. Rather than a 3-year average, it becomes a 5-year average. And this was done because it was just trying to address pension liabilities, you know, across the state, really. They do say that, you know, the new people are going to pay more of their pension over time. So they're funding it. So, you know, when the press is out there, or sometimes your neighbor who doesn't like the public employee, they think, oh, you're getting 80%. Everyone says, oh, they think you get 80%. Well, very few people get 80%. And in reality, you're paying your pension. If, you know, we send out statements once a year, and it's going to tell you how much you contributed, you know, from your deductions. Again, for most people, it's 9 plus 2. We still have a few members that are 5%ers. We have some that are 7. Then there's 7 plus 2, and there's also the 8 plus 2. But for the majority of people, they're 9 plus 2. And so that money is going into the system, and we're paying you right now 1/10 of 1%. That's all we're giving you on interest. But in reality, you know, our actual assumed rate of return is 8%. Some years we hit it. Last year we were at 7.5. We didn't quite hit it. This year we're already at over 14% so far this year. So it averages out. But it doesn't really affect your pension at all. What it does is it's really going to help the towns because it's going to lessen their appropriation that they have to pay into the system, which is seemingly where a lot of the anger gets, because you get some people on the different committees that are looking, oh, we have to pay this towards the pension appropriation. I had a call the other day, and someone said to me, well, just how much of the pension is the liability? And the liability is something we're addressing, you know, very seriously. We just knocked off, on Tom's leadership and the board, knocked off 2 years from it. And they said, how much of that thing? I said, well, off the top of my head, it's probably about 90%, but I'll figure it out. And it was like 91.46237%. So he goes, so you're telling me if we pay, my town pays $3 million right now a year, once we get past to 2029 or once we're fully funded, what would it be? I said, well, if 90% is for the liability, then you'd only be paying $300,000. And so then towns can, you know, do other things. Now, right now, every year or historically, even though it is subject to approval, we grant COLAs. So when you get your pension in time, you're going to receive your pension. But for anyone that was retired as of June 30th, 2016, got a 3% cost of living adjustment on July 1st of 2017, the retirees. But then, that was only on the first $14,000 worth of retirement. So these are one of the things, hopefully, as we build a healthier system, as, you know, the investments, you know, we have a very redesigned investment portfolio, a very modernized portfolio. The better we do, the better the towns can do. And then hopefully it can trickle down to the retirees so we can move that base up. There are other towns, they're at 15,000, they're at 16,000, they're at 18,000. Hopefully Plymouth County could be one of those systems that we can raise the COLA base in time. But also, Charlie asked me earlier, how are the investments doing? Well, we just passed a milestone last week where we hit $1 billion finally. So we are finally $1 billion system. That's the good news. The bad news is because people like Charlie and other retirees wanted to get paid yesterday, we slipped under $1 billion. So we're not quite there again, but maybe by the time I get in tomorrow, it looks like the market's, you know, doing well today. Maybe we get back over $1 billion. So that's our goal, is to still increase the value of the retirement system, the investments, while maintaining, you know, paying payroll, which is almost $9 million a month that we pay out in retiree benefits for all our members amongst Plymouth County. So there's options. You know, I'm going to go with Charlie's agenda, but it's also, I found this because I do these things in different towns, you know, sometimes firehouses, sometimes police stations, where we're interactive. So if you have a question, you know, just stop me. And the chances are your question is the same exact question as 3 other people are thinking about. You know, so it might not be on the agenda, it might not be something we get, but if you have a question, you ask it, then you might have answered 5 other people the same question. But at retirement, there are really 3 different types of retirement. Everyone's striving towards a superannuation retirement, and the superannuation retirement is basically just that. It's the regular retirement, and you get vested 2 ways. The first way, you have to have 10 years of service. So once you have 10 years of service, you are vested into a superannuation retirement. Then there's one other 2 things. Now you either need to be 55 and have 10 years, and you can start collecting, or you can have the 20 years of service and be any age and start collecting. Now, you have to still work. And if you're 55, if you're one of the old members, you're 55 in 10 years, well, that's only 15%. So that's not really, you know, it's great to think, okay, at 55 I can retire and walk off to the sunset, but it doesn't really work for most people. You know, then if you just go another 10 years, and you started at that 45, now you get to 65, and you have 20 years of service, that's 50%. So it takes you the first 10 years to get, you know, 15%, but then the next 10 years, you're gonna get 35%. And you're gonna see that multiple work from the age of 55 to 65 for the older members, probably for the newer people, the two people that I saw, it would be 60 to 67, which I call like the boom years. That's when the retirement percentage is starting to explode. And that's when, you know, people are really starting to, you know, fund their retirement, fund a you know, respectable retirement that they can, you know, live and not end up being the person at Price job. I mean, I was thinking the other day, we came back, my daughter and I think we were in Middleborough, as a matter of fact. We were coming back, we stopped, she had to go to the bathroom and pulled into McDonald's. And there was a lady there behind the counter, and she looked like my mother's age. She was 83, and she's like, Dad, why does this lady want to be here on a Sunday night? I go, she doesn't, but, you know, she just doesn't have that retirement income, you know, that we work for, that we're saving for. We're achieving, we're accomplishing every day. And so, you know, I feel bad for that lady. I mean, but I respect the fact that she's out to work, but, you know, we don't want to be that lady at the McDonald's, you know, at 8 o'clock on a Sunday night, you know, getting people's, you know, smoothies or Frosties or whatever my daughter wanted. So that's that. So that's what we're all working for. There's you know, the disability retirement, which is an option, you know, for a lot of people. We seemingly have 2 disability retirements a month that people come by, you know, and it's a protection. You know, there are some jobs that are more hazardous than others, and, you know, people are gonna more likely to get hurt, and it's a protection, so that you have this disability, you know, option in case you get hurt on the job. That you know, the retirement will still be there for you. Then you don't necessarily need the 10 years. Unless, there's another type of disability. One is on the job. It's, you know, the job caused you disability, and that's what we're going for. But otherwise, you know, people get sick too. And people get, you know, sick, and then all of a sudden they can't go back to work. And then there's ordinary disability. So it's not like you had to get, you know, injured on the job or something in order to collect a disability. There are different thresholds for an ordinary disability. You need 10 years of service, and it's not as lucrative as an accidental, but it's still an option for you, you know, that if something happens in your life, that the retirement system will be here, you know, to help fund your retirement. There's also plenty of people come in here and they've worked other jobs, or, you know, there's plenty of people that we have plenty of people that, you know, the women that, you know, raise families, get out of the workforce for so long, and then get back into the workforce. And so now they come to me and they're re-entering this system at maybe, you know, 50 years of age, but they think back, okay, well, when I was, you know, fresh out of college, you know, 25 years ago, you know, I worked, you know, doing as a secretary in the town hall, or I worked the State House, or I did something else. If you have prior public service within Massachusetts, there's a potential to buy back that service. It's real easy if you're a member of another system. And, you know, we have that. You know, you could work anywhere in Massachusetts. There are 104 systems in Massachusetts. We all operate under the same general rules, but, you know, we tweak them now and then. But if you worked at any one system and refunded your account, you can buy back that creditable service. You know, that's yours. And once you buy it back, it's almost like you never left. Some people, they may never have ever taken it out, and they're coming back, or they might go from one system to another. So you could have been working in Norfolk County. You could have been working in Hampshire County. You could have been working in the city of Boston, state of Massachusetts. If all of a sudden you leave that job and come here, the time's still yours. Conversely, the same way. You can leave one of the systems you're in now and go take another job. You maybe take a job at the state or wherever. The time is all portable. You don't have to start all over again. You don't have to start working towards 10 years.
Sorry to interrupt.
No problem.
Speaking to what you are mentioning, I did 7 years in Bristol County, transferred over to Plymouth County, and now done 3 years in Plymouth. Now, is it viewed as though I've done 10 years in Plymouth.
It's viewed as though you've done 10 years, and that's what we care about for you. In time, say that, you had 20, ultimately you get 10 years in, so now 20 years from now you retire. And you still had those 7 years in at Bristol. And now your pension's due, and we owe you, we're gonna pay you $50,000 a year. We're paying you that, and Plymouth County's paying you that, and Plymouth County paying you any COLAs, and your town is gonna pay your insurance. It's all happened. No problem. That's all you care about. Your last place of employment is gonna pay you all your service together in Massachusetts. Internally, because you work then 7/30ths of your career for Bristol County, then we're gonna bill Bristol County in the 3HC formula and say that, they have to pay 7/30ths of the pension. So we'll bill them and they send us checks. We have checks going back left and right between all sorts of systems, and it's a formula. There's some people like myself, I've been in multiple systems, so, I'm gonna retire from Plymouth County, but it'll be a bill to probably 3 other systems for my 3HC payment. So the member will never see any difference, but the 104 systems all make each other whole in time.
Just a quick note, when you ask a question, please raise your hand. Dave's been gracious enough, he's gonna answer all the questions, but I got a microphone here, I'm recording this for the future, so just raise your hand and I'll try to get to you quickly, okay?
What do you have to do when you go from one county to the other?
When you join our county, you're gonna fill out an enrollment form. And one of the questions on the enrollment form is, were you ever a member of another system? And then it's gonna be, are the funds still on account? If they are, we know, we reach out to the county, and they send us the money directly. You don't have to deal with the prior employer, and as a matter of fact, we don't want you to. Because if all of a sudden, the county or the prior employer is sending you money, and then us, it could create a tax consequence for you. Because now they're saying, okay, we're refunding the money directly to, or distributing it to that person, and then there's gonna be a tax ramification. There's gonna be a 1099-R attached. If they send it right from them to us, nothing. If on that application you say, yes, I was a member of another place, but I withdrew my funds, then that generates a question for us in order to calculate make a payment. And so we'll give you that option. The big thing there, though, for people to know, there are big advantages if you refund from the system and come back in order to start that refund process in the first year. If you start that refund process in the first year, the system is required by law to charge half actuarial interest. Our assumed rate of return is 8%, half of that's 4%. So the first year, you're paying 4%. If you wait until after, a year and a day to start this process of buying this back, now you're paying back 8% interest. And sometimes, I had someone, not too long ago, and she was dealing back, I think, it was 1982, she got a refund. She goes, well, how much is that? Ugh. So now it's 8% compounded. My general rule of thumb there is like every 6 or 7 years, it doubles. So people say, well, I didn't make that much money. I said, well, okay, but $1,000 refunded in 1982 is like $13,000 now. It can be a lot of money. So if you do come back to the system, it is in your best interest to buy that back sooner than later. And then other people say, well, I don't really have the money. Well, the other thing we can do is you might have deferred comp money. You might have IRA money. You might have some other, tax deferred plan. If we, just like the refund or the transfer from a system to us, if we take the money from the deferred comp plan right to us, no tax effect on you. Now, you don't have that money, to when you're going to retire and start, getting distributions later in life, but at least it's not used in, post-tax dollars for people that have to write us a check. At retirement, one of the things he's saying, options A, B, and C. There's 3 options at retirement. A is going to be the full option, and it seems like our 3 options are fairly well divided. A lot of times people come in to me and say, well, what do most people take? Well, most people don't take anything, and anyone that comes into my office is not most people. Everyone is an individual. Everyone has their own story. Everyone, what works for me might not be the best thing for you or for the last person that came in. So I really don't like telling you what most people is, but I guess the reality, the answer is, they're strangely evenly divided. A is a full retirement benefit, and you're gonna get the most. So when people talk about the 80%, or the 72%, or the 63%, or even the 30%, some people go in and they're content to take a lot less and start retiring, or they just started later in life. That is the full benefit. Option B is a lesser amount. It's generally about 1% to 2% less than the full retirement amount, but what that does is it protects the amount of money you put into the annuity over time. So at the end of the day, we talk about that statement that maybe you retire, you're at $75,000. That's probably gonna go down about $7,500, the annuity portion every year, and then after 10 years, there's nothing left in that annuity. If you had a deferred comp plan or an IRA, and you spend that $75,000, well, there's nothing left in there. So when I say the actuaries, the actuaries are gonna predict, a different age depending on when you are, how long you're gonna live, or what the average person is gonna live. For the most part, it's 10 to 12 years. And in my first example, if it's 10, it goes to 75,000, after 5 years, it's 37.5 is in there, and you had picked an option B beneficiary or beneficiaries, because you can name as many people as you want as a beneficiary. It'd be a one-time lump sum payment to your beneficiary or beneficiaries. And it doesn't even have to be a person. I had one recently. They named 2 churches as going to be their beneficiary for the B. You can do that. Option C is the double lifetime benefit, and now you can't name a church. On an option C, it's a double lifetime. It has to be an immediate family member. So, parent, sibling, spouse, child. Actually, you can even name a former spouse. They allow you to do that. It doesn't happen that often, but sometimes it does by law, and I'll get into that in a second too. So those are the only people, and then it can only be one person. So most people, when they choose in the option C, are picking the spouse. When I get back to what's right for me, when people say what do most people do, what's right for me, what will be right for me in time is I'm going to choose an option C. I just know that, and then it's a double lifetime benefit. I kid, even though I'm older than my wife, I've had this conversation before with people. I'm thoroughly convinced I'm going to outlive her, but we don't know. But the thing is that when I retire, it's going to be an important part of the family income in order to have that piece of that money come in. Now, if I'm wrong and I pass first, my wife would then get 2/3 of what I'm getting at the time of my passing. And that should get that for the rest of her life too. So that's a pretty good benefit. And I say that when we give the estimates, we always give people estimates, and we'll say, we'll have this figure for the member, this figure for the beneficiary. Hopefully over time that changes, and it changes significantly, because I say you get 2/3 of the time of the passing, not 2/3 of this amount, because hopefully there's a lot of cost of living adjustments in there. So, we've maybe now gained this, upped at about, $3,000, so it'd be 2/3 of that.
What if you, when you retire, you pick E or C, but what if I passed away and I, obviously aren't retired yet, and my husband's my beneficiary, what does he?
You're not retired yet?
No, like say you pass away before.
I was going to get to that, because I went to A, B, and C, and that's D. So that's right next. So that is right. Your question is right. What I have next, but
Just
on
one question on what
Sure.
you just did, Dave. Regarding the survivor, is there a COLA that they get too, or
they
no?
absolutely get it.
They get the COLA too?
The only thing the survivor doesn't get in time is the ability to vote in our elected elections. So we have 2 elected members. Our board is comprised of Tom O'Brien is chairman of the board by virtue of being treasurer of Plymouth County. We have 2 elected members, Joe McDonough, John Sciarra. Every 3 years, their term's up. We have a 4th member who's appointed by the county commissioners, and the 5th member who's appointed by the treasurers of Plymouth County. Those are our 5 members. The only thing that the survivor doesn't get to do is vote for the 2 elected members. But they get the COLAs. They still have to file the affidavits every year, because every 2 years, and actually we're mailing them out today, we send out retirees letters basically saying, hey, are you still alive? We need proof. I mean, there was a case of this bum in Florida a month ago. He buried his mother in the backyard. And he didn't want to, because he didn't want to go to the funeral. He didn't want to, lose Social Security that the mom was getting. So he didn't kill her. He wasn't that bad of a guy. But he didn't want to lose Social Security, so he just dug a hole and stuck Mama in the backyard.
So what would be the difference between A and C?
Well, C, I mean,
The amount.
A again is full amount.
Right.
C depends upon your age and your beneficiary's age. So there's that haircut. And that haircut, when I talk about the haircut for the option B, is usually 1% to 2%, and then that only matters your age. The option C haircut depends on both your ages, so we're taking into account, and actually, for whatever reason, it's your half birthdays. They don't say, okay, he's 70 and this person's 67. It's what half birthdays you are. Every time someone gets another half birthday, the chart changes. And they have every configuration from, 100 all the way down to 18. And before you think weird, okay, well, why is someone who's going to be 90 years old having an 18-year-old bride? Because most people are doing spouses. That's kind of weird. Well, it is, but you can name a child a C beneficiary, and people do that. It's not as much as spouse, but they can do that. So then the haircut between, when you're naming a child as a beneficiary, it's more than 10%. It might be 20%. Because again, the actuaries are now thinking, okay, in my scenario, I'm 4 years older than my wife. They say, okay, he's going to live, 12 years, but then the wife's going to live 16 years later. So we're going to figure out that we're going to actually have to pay both over this amount of time. So that's why they take that difference between A and C. And again, it's probably the actuary's projection that over time they pay the exact same amount. You just get it differently. So it just depends. It just depends, and there's every configuration, and that determines then what the benefit is. Now, if you're the C, and all of a sudden your beneficiary passes before you, now you're popping back up to option A. Now you're getting option A amount for the rest of your life. So you get that. Now, when it's C again, in all selections, when you retire A, B, or C, you can't change your mind. At 5 o'clock on the day of retirement, that gets locked in. And we tell that to people. People can come in no more than, or they can come in anytime, and we encourage people to come in anytime for family planning and financial planning, but you can't file your papers outside of a 120-day window. But once you're inside of a 120-day window, you can come on in and fill out your paperwork. And then up until 5 o'clock that day, you can change your mind. And it happens. People give notice. Town says, hey, maybe we want to keep you. Maybe we'll give you that raise you deserved all along anyway, because we want you to stay another year. So if that's the case, no problem, you can change your mind. At 5 o'clock, you can't change your mind.
I know when I retired, and I don't want to give all kinds of stories, but I went down and I was thinking about life insurance, and doing that for my wife instead of the option C. But what was it, about 10 years ago, you reevaluated that and did new formulas. I think it was around 9, maybe more now, 15 years ago. And the new formulas are very favorable. And I couldn't come close to it. And I don't smoke. I had a fairly lucky health history. And I couldn't come close to it with life insurance, providing her two-thirds.
2003, the option
the
C,
amount,
option C factors changed. So if the haircut is 10% now, it might have been 18% then. So it made that a lot better. And I said I was going to get to option D next, and I promise I'm going to after this next, because, if you're talking about life insurance, a lot of times people come into me and say, hey, I hear that, Charlie in my department says that you can get life insurance, so we don't have to get C for the wife. You can still get the A, and we can hook her up with the life insurance, and she'll be all set. I'm not big on that. I think if you look at the math, I'm just not big on it. And one of the other things, too, is, I'm going to tie these two things together, is we had somebody the other day, and she had been inactive for a long time. But now she's 56 years old. She was a para. She had $28,000 in her account, and she wanted to withdraw it. I'm like, well, why do you want to withdraw your funds? You can start collecting a pension now, because she's not going back to work. She's like, well, my financial advisor said that he can do better than that. So I'm like, okay, well, if you retire today, I'm going to pay you $7,000 a year. Not life altering. We're not going to be able to afford a place in Trump Towers on $7,000 a year, but that's $7,000 a year every year for the rest of your life. Well, my financial advisor said, well, okay, that's just like the insurance agency. And I said, there's a big difference between your financial advisor, potentially an insurance agent, and me. I'm not working on commission. And the financial advisors, sometimes when they're giving you advice, they're also giving you advice that is in their best interest. Same thing with the insurance agent. Insurance agent's going to make a commission on this the rest of his life. We don't make commissions. So I'm not going to tell you what to do, but I'm going to show you the math. And if you can find any financial advisor out there that's going to turn $28,000 and do better than $7,000 a year, which is 25% return each and every year for the rest of your life, well, hook me up. You know, I want that guy, but it's just not reality. It just isn't reality. So when people are looking things, you know, other ways, you know, that are better than this system, boy, I want to cut the cards. Come talk to me. I'll show you the math, and I promise you, I mean, I'm not going to make a decision for you, but I'll try and get you to ask yourself questions and try and do what I think is in your best interest. And I'll do that for each and every person here if they ever come into me.
I have just a couple of questions. One is, if you wanted to name like 2 kids beneficiaries, is that possible?
You can name 2 kids the option B beneficiary,
Okay.
and where you're leaving money, you know, potentially to a lump sum. Now, the other thing is when we do the math, when people choose option B, and if they pass and they chose B, there's usually nothing left in that account. Most retirees live more than 10 years, at least the ones that aren't getting in an accident. You know, life happens, you know, plenty of people don't get there, but for the most people that we do the option B, there's nothing left in that account. We did one recently, and we had 3 children named B, and he had a whopping $47 left in his account. So we had, you know, 3 checks for $15 and like 87 cents to each. But if he lived like 4 more days, there would have been nothing in that account. But you can do that, and you can change that. Now, as I said, you can't change, once we hit 5 o'clock in your retirement day, you can't change A, B, or C, but you can change who B is. Like under C, you can't change C no matter what. You choose C, and you're locked into C, you're locked into the C beneficiary. And people all of a sudden will call me up and say, okay, you know, I'm getting divorced, so I want to change my beneficiary. I chose C when I retired. Sorry. That ex-wife is going to be your C beneficiary for the rest of your life. So there's no changing that. Now, after that person named the wife as the B beneficiary and then gets divorced, if the courts allow, they'll allow you to change the B beneficiary. Or if one of your beneficiaries passes, you know, you can then change that too. You can always change the B beneficiaries midstream. You can't do it at all with C. There's nothing with A.
With A, there's no beneficiaries?
With A,
Your maximum amount?
you're getting the maximum amount for the rest of your life, and that's it. Now, the reason sometimes people choose B, and I get it, I'm not a B guy, because I'm a math guy at heart, and I'm always doing the math. I mean, as I said before, I'm taking C, but I get the A, but the reason some people take B is they say, okay, they might have $100,000 into the account, and I'm telling them, okay, 10 years there's going to be nothing there. You know, 5 years will be $50,000. It's a declining amount. Every single amount gets lower and lower. And these people are like, well, geez, you know, if I pass in 1 to 2 years, I don't want to leave the county my money. And so I just can't deal with that. I'd rather take $40 less a month knowing that the county isn't going to take my money. Well, in reality, that is the truth, because if there is something left in the annuity account, we absorb it, you know. But, you know, it's supposed to offset, you know, the extra B we pay, because most people that take B, we're paying the annuity for the rest of their life too. You know, so no one complains about that when they say, okay, the annuities run out, and now the county is paying that annuity all the time again. But they don't want, you know, government, Big Brother, whoever, to keep their money. And so I get that. If it makes them feel better at the end of the day, they can sleep better at night, not knowing that, you know, the county's going to keep their money if something happened to them, then B is right for them. Then B is right for them.
I think the other thing too, a lot of times people have health issues and they know that the likelihood of survival isn't that great, so.
Then you're probably really better off doing C.
Well, some people, yeah, I would think so. Yeah.
Then the math on C just, it probably makes the
Much
most
better
sense.
off, yeah.
But I mean, not everyone has eligible beneficiary like that, or they don't have, you know, they might have been single their whole life, and their beneficiaries could be, you know, a niece or a nephew, and they can't do it. So that's why they choose B. So there's plenty of times B makes sense, but I'm not big on it.
What if you have a spouse and you both in the same goes right to Plymouth County.
I mean, there's plenty of people that do that, and they do double Cs. They each do Cs, and that, we get that a lot. And so then what happens there, when one passes away, you know, they're gonna get less coming in from their spouses, but then they're gonna get more on theirs. So it's, the net offset isn't dramatic when, you know, when they both do it that way. So that's very common, and it's not just both in Plymouth County. Again, could have been one in Plymouth County, could have been one at the state system, could have been one at Bristol County, could have been one in the teacher system. You know, so it's very common that you get, you know, the double C. What's also common is that the husband will choose C because maybe his job was paying more money, and the wife was a para, not getting quite as much. So the husband's taking the C, protecting the wife, but the para, the wife, was just going on her own and taking the A. You know, it can make sense.
Just one other question. Right now, I'm paying into life insurance with the town. Can that be continued once I retire?
Depends on the town, and sometimes depends on your age.
Okay, it's Middleborough.
Yeah, I mean, you know, all insurance is a town benefit.
Okay.
You know, and so, you know, what we do, when you're retired, we'll take out money for your health insurance, but then all we do is we pass it right back to the town.
Well, it's not health insurance, like.
Well, even life, but the same thing, or it could be dental. But some towns offer dental, some don't. Some will offer the life, but then they stop at 70. So it just depends on what the town plan is.
Yeah, I'm in Middleborough retirement, I do have the life policy, but you know, you want to review that on every 5 to 10 years, because it does go up in cost as you get older. And like David
Every
said,
fifth birthday.
you know, it's a good idea every fifth birthday to review that. But yeah, they do take it out of my check on a monthly basis.
You know.
I'm gonna get to him because he's been,
Question, if you try option C and the spouse passes before you do go back up?
it pops up to option A at that moment. At that moment in time, then you get the option A. And eventually too, when you retire, we're gonna ask you for 2 beneficiaries, because if you chose, you know, say a spouse is a C, and that's clear, so we have that person, but we're even gonna have another page for beneficiary and say, well, what's this other beneficiary? Why do I need another beneficiary when I'm naming my spouse, and if my spouse passes first, then I get it all? Well, the reality is, we pay the last business day of the month for the month just lived. So if somebody passed away on November 15th, we're gonna owe someone for those 15 days. Now, if you're taking C, then we'd pay you for those 15 days, and then we'd put the spouse at the new rate for the next 15 days. But say the spouse passes first, and now you pop back up to option A, and 30 years from now you retire in the middle of a month, we owe somebody for 15 days. So that's why we're gonna ask you for another beneficiary, just to make our life easier, to who to pay those like days that are stringing along. Most cases like this, again, most people that choose C are gonna name the spouse as beneficiary, and most people are gonna name, you know, the contingency beneficiary, all children equal shares. Every once in a while, you know, some people have favorite children, they'll give one a little bit more. When I ask women, and this is a common thing of women, I ask the women, do you have a favorite child? I don't have a favorite, but I have a least favorite. And so you can do that too if you want, but you know, that's entirely up to you. We don't judge when you're picking your beneficiaries.
I'm just confused. I get what A is, but can you just tell in real simple terms the difference between B and C? If you named your spouse for either of both of those, what's the difference between if you took D or if you took
If the big difference is if you choose C and your spouse survives you, your spouse is going to get something the rest of their life on for C. For B, there may or may not be something there when you pass. And again, the math tells me that more cases than not, there isn't something there. There's more of my B beneficiaries get nothing than get something. And again, keep in mind, it's a declining amount. It gets less and less and less every month until there's nothing there. So the only guarantee as a retiree is the member is going to get paid something for the rest of the life. It just depends on which option you choose is what happens when that member passes.
So when Plymouth County, correct me if I'm wrong, but when they figure your retirement, when you go down 120 days, they figure out how much you've put in, plus the interest, plus untaxable, add it all up, and say the figure is $100,000 over your career. then they divide that by a factor, and so much of that comes back to you as an annuity each year. Now, that's the amount that would come back after you died, is that correct?
Correct, because there's a B factor which determines what the annuity is, and unless you chose option B, it doesn't matter to you what the difference between annuity and pension is. It's really more of an accounting factor to us, and how we do accounting and what that annuity is. Because a lot of people, when we send them the estimate is, what's this annuity and what's this pension? Well, at the end of the day, you really only care about the gross monthly amount. That's what you need to focus on. But at the end of the day, too, the annuity is kind of a return of your contributions. The pension is sort of the town share, the employer's share of your pension.
David, one other question on the annuities. Is there any tax difference in the way that's dealt with in the IRS from federal level right now? It's probably going to change this month, yeah, but.
It could, but I don't think so. I mean, in January 12th, 1982, who's a member before that day? January 12th of 1982. Any contributions you made in your paycheck prior to that, we're taxed. So then when you retire, you're going to get a tax break on that. For the people that retire, or started work after January 12th, 1988, then they changed the tax code for when you get paid. So if you're getting paid, $100 a month, and we're taking out $7 for retirement, you only pay taxes on the 93. Back before January 12th, 1988, it was you paid taxes on the whole $100. So that when in turn you retire, you're going to get a 1099 from us at the end of the year. There's going to be a gross pension amount, and we figure out for you what the taxable portion is. And we feed that to you so that you can do your taxes and whatnot. The other thing about taxes is, as long as you live in the state of Massachusetts, you don't have to pay. Well, right now you don't have to pay Massachusetts state taxes on that. Our
82 or 88?
January 12th, 1988. 90. I got the twos. But, so the taxes depends on, though, what state you live in. The second most, our retirees, the second most popular state is Florida. Florida doesn't charge you taxes. Third most is New Hampshire. New Hampshire doesn't charge you taxes. Fourth most is Maine. Maine does charge you taxes. It depends on where you're going to live. The Carolinas are also charging taxes. But the other thing I don't always like to, talk about taxes and say that's a guarantee, because Massachusetts could change that next week. New York could change their code. So, that is not for the rest of your life benefit. The only thing for the rest of your life benefit is Uncle Sam is going to get his. We know that.
When you're figuring out whether or not you want to retire, a lot of people that I talk to anyway, always say, well, gee, I need to stay because I need to make the money. And if you look at, you're paying 9% plus 2% or 8% plus 2% for retirement, that won't come out of your retirement, and a 7 or 6% state income tax that doesn't come out of your retirement, you're already up to 16% out of the 20.
And now, don't forget MedFICA, which is another 1.45.
Yep.
Don't forget a lot of people union dues.
But by the time you get done, I figured mine out when I hit my 80%, and I was paying $50 a week to go to work.
It does cost, once you've hit the 80%, it's crazy to stay on. I mean, but you can. But I want to get to option D. I kept saying what option D is, because I'm a big believer in option D, but one of the biggest misconceptions in option D is what is it? Is it the fourth option at retirement? No, it isn't. There's still will only ever be 3 options at retirement, which is A, B, and C. Option D is for when a member dies while a member. And so right now, we've had everyone, when they fill the enrollment form, fill out the option D. And we have your beneficiary or beneficiaries. People can split it out. What option D does is, if you choose one, it changes what we do with it if you pass away while a member. Right now, if you haven't chosen option D beneficiary and you pass away, we're going to pay your beneficiaries the lump sum amount that's in your account at the time of your passing. And so say it's $60,000, it could be one person. We'll write a check, $60,000, say sorry for your loss. It could be 3 people, maybe 20. Sometimes people do, 80% to 1, 10 and 10. It's all over the place. But that's what we do when you have a D designation. The options to choose a D is the same as option C. It has to be an immediate family member. It can only be an immediate family member. So what happens there is, if you've passed away and you've selected an option D beneficiary, would almost like would retire you that day, would put in the option C factors and say, this is what your beneficiary is going to get then for the rest of their life. So that if you again, I go back to being a math guy. If we look at the, it's almost like you retired as a C that day without the 2/3 reduction, and the beneficiary gets that for the rest of their life. It's a pretty good deal. Now, if you've been married 1 year, working 2 years, and you're married, legally living together, it is a legal distinction. And you pass away, even if you don't have an option D designation, the wife can come in and say, rather than taking the lump sum, I'm going to take this amount, and I'm going to choose me as an option C, and I'm going to take that. So the wife or spouse always has the ability to drop a trump card. There's also minimums. Last year, tragically, one was probably October, one was December. We lost 2 young members. Didn't have much time. But their C calculation would have been, $100. But in that case, the minimum C, because the board adopted this, would be $500 a month. Again, not great, but better than nothing, and certainly better than return of the deductions.
So, David, for option D now, is there a requirement that that people should be looking at doing before they retire?
Well,
Or
it's
is
only
that
available
automatic?
before you retire.
What's that?
It's only available before you retire.
Right.
So you can't do it. Now I think, I'm a big believer in D. I think almost everyone should have a D designation. If you only have one child, it makes it really simple. You should name that one child as your D beneficiary. Because in this case that, something happens to you, the spouse can still go in and drop the trump card and say, no, I'm taking this for myself. But say the tragic accident, there was a family of 5 got killed last night in New York. 5 of the 8 were all in one family all together. Maybe it wasn't a family, but there were 5 together. And, you both go at once. Now what happens? If you've named your spouse the regular beneficiary, and, she has the ability to drop the trump anyway, but what happens now if there's no contingency beneficiary? We send the money to probate. We send the money, or eventually it's the estate that determines who gets your money.
So would you suggest that the towns, if they want to take care of their employees, send out a notice to them to put people, to have people look into
I'm a
selecting
big believer in
beneficiary?
D. I mean, I'm an absolute big believer in D, and what I did, as I said, I keep going back to, if you have one child, this is real simple. This is really, really simple, because you name that child, because potentially, if you both go, you can, then that child can collect on your pension for the rest of their life. Now, it gets complicated if you have the two children, or in my case, I have 3 children. In my case, I've named my son as my option D designee. And I told my wife, I said, hey, listen, I'm not trying to ace you out. So if something happens to me, you go down to Plymouth County and say, hey, okay, I want to collect on this. Why did he name the son? Why didn't he name me? What did I do? No, I explained it to her. This is what I'm doing. This is the case we both have an accident at once, and we both go. And then it's like, well, why'd your son? I mean, you have 3 children. I said, okay, well, I picked my son because I also had a conversation with him. I'm going to put this into 4 buckets. You're going to do the right thing. You have 2 sisters. You're going to give your sister 1/4 share. You're going to give your other sister the other 1/4 share. You're going to take a 1/4 share for yourself, and then last share goes to Uncle Sam, because the county is going to do a 1099. It's the person of record can only be one person. So it's a way of doing a contingency beneficiary. I can sell that better to the males that come into my office than the females. Females seem to have struggled if they have more than one child. I can't pick one over the other. I just can't do it. I'm like, well, I'm not trying to play favorites either, but I'm just thinking, okay, the math is that this is, it would be in everyone's best interest. Now, granted, they're going to lose both parents, and that's going to be tragic, but the retirement system's going to be there for that family. And I still think that, if you have 2 children, if you have 3, pick the one you trust to do the right thing.
So you really made me think about my beneficiary. How do I go about changing?
Easiest way is to go on our website, and we have a change of beneficiary form. Change of beneficiary form. Now,
That's something you can do prior to retirement, right?
oh yeah,
Once you get an account.
oh yeah, no, and it's something that I think people should always be looking at their beneficiaries. That's one of the things when we send out the statement of account, we put who the beneficiary is on it. I had somebody come into my office 6 months ago now, and he's looking, he goes, oh, my beneficiary, it's my old girlfriend Sally. I've been married to Jane for 2 years. Can I change that? I said, yeah, it's advisable. So yeah, people should always be looking. I mean, life happens. When people are filling out their enrollment form, is usually when they're filling out the beneficiaries. So for the most people, it's the same. They don't change it. But, life changes for everybody. That's the only guarantee, is that something's going to change. So think about your beneficiary constantly. And you can change it as often as you want. Going on our website, filling it out, sending it in to us. And we'll change it right there.
Is option D a separate form?
It is. So when you get the change beneficiary form, it's going to be 3 pages. The first page is going to be an explanation. The second page is going to be basically, they're going to have like a bunch of different lines. I think they give you 4 to name people, and that would be the lump sum distribution. And then option D is the next page, the 3rd page. In that page, they're going to ask you the relationship to make sure it's an eligible option D person, the person's age, social, and that, and then somebody to sign it. Now, when they do my scenario of naming a child or as that, I always say to these people when I'm able to talk them into it, have your spouse sign it. So make sure they understand what you're doing. You're not acing them out. And if something happens to you, they're going to come into me and I'm going to advise them what I think is the best thing. Now, the only caveat with choosing someone as a D, now you're locking yourself into a D. Now somebody's taking a D one way or the other. Whereas in the other case, if you just left it alone and named somebody as the lump sum beneficiary and the member passes, the spouse can go in and say, okay, I'm going to look at the math here and say I can either collect it all up front or I can take this amount for the rest of my life. Then they have a choice. But if you name the option D, even your spouse is an option D beneficiary that's locked into life, then they have to get that for the rest of their life. And I've had people do that before too. I've had people say, I can't trust my spouse. They'd take all that money and they'd go out to Vegas, they'd go to Hawaii, they'd spend it all in a year. So I'm going to force that person to collect, on a monthly pension. That's okay. I mean, you can decide that too, but you are definitely locking from the grave. You are locking into, your survivor's decision for them.
So if you take the option D, you're giving them a lump sum?
There's no lump sum.
Okay.
When you take an option D, the whole lump sum is gone for good.
Okay.
It's only either you name the person there, or the spouse has the ability, if somebody else, then the D is the D beneficiary, the ability to trump card it.
Is there a reason in your story that you're not splitting it up 4 ways? You're only splitting it up?
In my scenario, I split it up 4. As I said, 1 for each child, my son, each daughter, and then the 4th bucket for federal taxes. Because one person is going to get that 1099. And so in my scenario, my son would get the 1099 and he'd have to pay taxes on that whole amount in addition to everything else like his salary. So he has to pay all the taxes. So I'm telling him, okay, give your sister that, give the other sister that, and then use the difference to pay the tax effect of it.
You're giving it all to one son, correct? You can only name one beneficiary.
You can only name one beneficiary. Yeah.
Basically, you're telling him to set up like a trust would be.
Yeah,
He's
I'm telling
responsible
him
for
and
it.
tell him to do the right thing.
Yeah.
And then I've also told other people what I did, so that in case, there's nothing would guarantee him to do it, that, I've told both my sisters, this is what I'm doing. If he shortchanges his sisters, make sure he does the right thing. But then that benefit would be the rest of his life. For people that are doing that, my son is 24. I also have a 15-year-old daughter. Well, the math there might say, choose the 15-year-old, because she's probably going to live longer. Well, in time, when she turns 18, she might be my D beneficiary. You can change that. So you're not locking yourself into that. But trust me, my plan is to retire on my own and collect my own retirement. But again, I said, life happens.
My son is 40, and I have him named as my beneficiary on the regular form.
Mm-hmm.
Would it be more to my benefit or his benefit to choose option D?
Do you have any other children?
No.
I think it's simple. I think,
D as opposed to the regular?
absolutely. Again, I think if something were to happen to you, then he'd get a monthly benefit for the rest of his life rather than the lump sum. And I think that you would see that it would probably be 4 or 5 years before it just totals that out. You know, that's unfortunately, sadly, there's no guarantee something could happen to him before we pass that threshold of the break-even point. But again, I'm a math guy, and you play the percentages, and I think it would work. But if you have just one child, I think it's an easy decision.
I would do two if you did the extra for the tax purposes, would that be beneficial?
Well, we don't expect, if you only have one child, we're sending it to him anyway. And then he'd figure out the taxes. He'd figure out his own taxes. Yeah. Sure.
So is D only if you die before you retire?
D is only available when you're an active member.
Okay,
When you're retiree, then it's A, B, or C.
okay,
There's no such thing.
all right.
But the D is kind of like the C for the retiree.
Okay, okay. So you would have D in place, because you haven't picked an A, B, or C yet?
Correct. But you have to proactively choose a D.
Okay.
If you pick a husband on the D, spouse, and you both die before, you retire,
The lump sum would go to your estate.
okay.
And that's why I named my son. Yeah, that's why I named my son, in case we both got in an accident and went together. Yeah, but if it was the other way around, you know, eventually, we're not keeping your money. We're gonna pay somebody, and it would, eventually it goes to the estate. When we have beneficiaries we can name, we can write checks right away, and it's simple. Estates, probates can take a long time, and can tie up money. It's all on our website, yeah. You look under members, and then drop down, there's forms, and we have forms for everything there. Even if you're gonna retire, you can fill out the form, you can fill out the forms before you even come in. I don't always suggest it because invariably people are unsure about things or make mistakes, so we correct them, or we'll go over it then, but.
There's a forms under the Twin Leads too,
Yep.
on the left side.
Oh, yeah, we have them there as well.
If you're going to retire, when should you make your appointment with the retirement board to see them? If you're thinking about it.
When you're thinking about it, I mean, there's no right answer to that either. I always think coming in at least a year, 2 years makes sense. You know, because sometimes, you know, I had somebody come in and, you know, she made up her mind and she's retiring December 1st and she gave notice and she was just in last Friday. Her birthday's January 15th. You know, if she came in a year, I'm like, and she was only, you know, 60. You get to that next birthday, it's a big jump. So, you know, so I think by coming in a year, 2 years ahead of time, sometimes we'll look at different days and what's best for you, what day to retire. Because, you know, birthdays are big. Once you hit 65, then it's months. Months are important. Because the calculation on a retirement is based on 3 things. Age at retirement, no matter before or after April 2nd, creditable service, and then average salary, either 3 or 5 years. Once you hit 65 or 67, then the age stops. But for this person, this example that she came in Friday, she's 60. On January 1st, December 1st, she's 60. Her birthday, I believe, was January 17th. She's 60, and she doesn't turn 61 until we put that other candle on the cake and sing happy birthday to her. And then that factor changes that day. Now, creditable service, you might have started on, you know, September 1st. But once you get past 10 years, every time you work the first of a month, we're going to give you another 1/12 creditable service. We don't make you go the whole year. A lot of people have, oh, my anniversary date was September 1st, so I got to get to then. Well, at some stage, it doesn't matter a whole lot. You're adding a 12th. It's not as dramatic as the birthday. So when the birthdays you want to get to, you know, it's really important for the months of credible service. It's less significant, but again, if you start on September 1st, don't leave on, you know, August 28th just because August 28th was a Friday. Same scenario. You're going to cheat yourself. You're going to get that close. So when people come in a year ahead of time, you know, we talk about things like that. Ultimately, you can't file your paperwork until you're in that 120-day window, and you can do that.
Just another point too now, sorry, and I'll let you, give me a chance to walk up here. When you go in, you might want to go in early if you're contemplating buyback. You know, even if it's 10 years before, I think you mentioned that earlier. You want to buy back as soon as you can to avoid, based on your circumstances, obviously.
We try and get people to buy back right when they re-enter the system. You know, that's going to be our goal there on buybacks, is get people right when they enter the system. But the other thing, I just want to stay on point a bit, is the 120-day window. And this is for, most people do that, and they do it naturally. Every once in a while, and I just had somebody, I got paperwork yesterday, and her retirement date was August 11th. Well, now, once you pass 60 days on the other end, I can take it. She wanted me to back up to August 11th because that was the last day she worked. But by law, once you've come in after 60 days after the last day you worked, I'm going 15 days into the future. So she came in, you know, if she came in today with it for August 11th, no, her retirement date would be November 16th. So it doesn't happen to most people, but once you are retired, you know, get in, or at least get in before, you know, within the 60 days of your last day of work. Oh, I'm sorry, she was first.
Oh, I was just gonna say, so whether you're far away from retirement or close, kind of like a little PR for your website here, they can actually go onto your website if they're a member, and you can figure all that. It will actually tell you kind of like when the best time to retire is, whether it's like your birthday, and you can put in the different dates you're thinking about.
You can put in the
and it shows you what the payout is.
It does, and it's a great calculator. What if you're doing it now, though, what it's going to capture in time is your current best 36 months. Because the average salary is, a lot of people, you know, it's the high consecutive 3 years. In reality, I mean, because the way a lot of payrolls go, it's 36 months, but we can divide a year into anything. So a lot of people say, oh, I'll get to December 31st because that's going to be the end of my year. Well, if somebody retired yesterday, we're going to make their 3 years, you know, November 1st, the year before, to October 31st. So we'll divide a year, whatever makes best sense for the member. And that's what we'll do.
And you already have the data, so when they go in and put in their name and social security number and sign up, you're pulling their specific data to get this.
We have a lot of the data.
Yeah.
You'd be shocked. I mean, I get people will come in and, you know, it's the beneficiary. And we know it was, you know, it's Mary Smith's coming in and John Smith's the beneficiary. But we don't know John's birthday. We don't know who John was. A lot of times it's a spouse, because if the system didn't know, the system's going to put unknown. And they're going to have, you know, gender, unknown. You know, so it's going to be there. So if you don't have those three things in there, your beneficiaries aren't correct, they're not going to do an option C calculation for you, because it's not going to say, the system's not going to recognize you as having an eligible option C beneficiary. So the system has limits in the sense that if we have incomplete data, it's only going to give what we have. But for the we know your starting date, we know the salary we have, you know, from the town. Sometimes we're back because, I mean, right now probably, I don't have anyone's October salary information, you know, so it will just show, you know, September. So in reality, probably what you earned in October of 2017 was better than 2014, so it's a little bit better now, but, you know, it's only going to have what we know and what we've put into the system as well.
So I went into your office over in the Quarry at one point because I found out about the buyback. I'm eligible for 4 years of military buyback. They told me to wait.
You can, because for the military, they don't charge interest. But there's also, I mean, the reason you were told to wait is once you've been officially notified of, you know, how much it would cost to buy back that time, you have 180 days to start the process.
That's correct.
So they probably didn't officially notify you to not start your clock. On a military, if you have military service, you can buy back up to 4 years. It's 10% of your salary, annualized salary, when you enter the system. And you can buy back up to 4 years. If you're in reserves, it's 1 for 5. So in order to get 4 years of that, you would have needed 20 years of reserve service. The disability retirement depends whether it's accidental or ordinary. An accidental, you know, so you got injured on the job. So if you're ordinary, then it's ordinary. It depends on your age. First, you need 10 years of service. Kind of what it does is bumps you up to 55. So it'll give you another probably 10 years of age to your factor. How is creditable service computed? It's basically, for most people, it is, it's everyone, it's month for month. Before this, we gave creditable service if you had $5,000, in earnings in a year, people got creditable service. Last year, in order to help out the towns, because amongst our member towns, some people are doing it one way, and other towns doing it a different way. We saw clarity. It's basically, if you enter into the service, we try to get the rule going as of July 1st, but PERAC didn't approve it, and we didn't receive it until I believe it was August 25th, 2016. You need 20 hours a week in order to be eligible to be a member. And then once a member, always a member. So that's how that service is calculated. There's sometimes the service calculated, now you come in, you say, okay, well, I wasn't a member, I worked in Carver, a bunch of summers, and I did these odd jobs, and I wasn't a member there, but I did work there. Well, if you worked within one of our systems, we're going to allow you to buy back that time, but we're also going to condense it. So if you work like 10 hours a week and did that for 4 months, and that job is really, the full-time job is considered 40 hours a week job, then that would turn that 4 months into 1 month, or 4 years into 1 year. So it would allow you to buy back some service before that wasn't, you weren't a member, but it's not always, day for day. That.
Did you say that just changed?
It changed with us, because we.
But it's not started.
Correct, so if say somebody was a member because they earned $5,000 plus a year in 2015, and that's all they still make, they could be a recess aide. We have some recess aides, and that's what they do. They give the teachers a break, and they go cover recess in the schoolyard. They don't make much money, but if they're making $5,000, they were a member of the system, they're still a member of our system. But if that recess aide, started today in a school, now you need, the threshold is 20 hours a week in order to be a member. But anyone else, again, we grant, the whole grandfather thing, yeah, we don't take rights away from anybody, nor does the state.
I do payroll and benefits, and I've had a couple instances where years ago, when someone started working, because like now, you start employment when you're a member. Well, years ago, you didn't become a member until the paperwork was processed. I guess this was many years ago. So I've had some retirees who said their starting date was wrong. I put like 3 or 4. Like, why was that? Like,
Some towns put people on probation. Some places, they didn't give us the membership date or whoever was back then until they actually, the first deduction date.
yeah, like, I guess I understand they used to have like monthly meetings, and then they'd allow the member, the employee to come in. So they would call that maybe a month or
Yeah.
two later as their start date, but.
It shouldn't be. It should be the day they started. We've done that. We've gone back and had corrections. So even corrections from 25, 30 years ago, if I can get something from the town then.
It's hard to find sometimes.
Oh, and I know.
25 years ago, if it's not in their folder.
Every once in a while, we send you people to archives and we can hear the tremble in the voice. No one wants to go down the dungeon. We get that. But, we need proof. If the day is changing, we need proof. I mean, that is, one of the things we do at our monthly board meeting is we approve for members. But it's a starting date. But things, I guess, were done differently, a bunch of years ago. But then if that's the case, we just need a piece of paper, we'll make the correction.
But can I ask like one more question? I do it. I've had like 3, 4, maybe 5 people that's happened 2 years ago. And I find it for them, and it takes a lot of work.
Well, I know.
In the dungeon. Is it really worth it? Like, that month, like, really, like, does it add like another $5?
It will add something. I mean, yeah, and if we add, people always take it. No one says, oh, I don't want that extra $5.
Well, the other thing you might consider is if you're at 80% and you want a full, complete retirement at 80%, which carries some other federal benefits too, a few small ones. But, that could make the difference if they retired at a certain date.
I mean, I do it. I just want to know.
Very seldom does that happen, but it could.
It's not the sexy part of the job, but I mean, I think, we're all into membership services, and sometimes, at least with us in Plymouth County, if we can do something that's going to benefit the member, we are gonna do it. We're gonna do what we have to do, so.
Just kind of remind me of a question. If you have time to buy back, do you have to buy it all back, or can you buy back what you need?
You can buy partial, yeah, I mean,
Can buy
you can, but, now, and this happens a lot of times with militaries every once in a while. Someone will buy back, you know, he was, you know, in the military, comes out, now he's a cop, and he buys back his 4 years, and he works, but he works, you know, now he works 30-year career. Hey, I only needed 2 years in the military, though. We're not gonna sell it back to you, though. So you can buy back partial, but once you bought it back, there's no refunding it, you know.
I wasn't put in when I was supposed to, because I bought 17 years. So I don't necessarily need to buy back all 17 years,
Mhm.
because I'm already 62,
Yep,
but,
we can look at it, yeah,
okay.
yeah,
So you can just buy that.
sure.
If you have social security too, does it matter what you do first? How does that?
Social Security, yeah, I mean, that's the other hot button issue, because it affects almost all of us. It affects almost all of us that, you know, Social Security, thanks to Ronald Reagan, is gonna care what we pay you. And they're gonna take what we pay you and offset what they pay you. And they have a very complicated formula based on many different things, and they're gonna use in the offset. Now, some people that come in later in life and they have 25 years of what they call significant earning years, then the offset's less. Actually, once you hit the threshold of 21 years of significant earning years, the threshold's less. Once you hit 30, it disappears. And there's a web calculator on the Social Security website, and they can show you dating back, I mean, I have it with me right here, to 1937, what substantial earnings was. And it's not that much in some cases. I mean, I'm thinking, okay, I was a teenager in the 70s, and it was, you know, in the $4,000 range. Yeah, that was substantial to me when I was a teenager, but, you know, maybe not to somebody else. So substantial is subjective, you know, so let's not just get scared off by that word. Let's look at the chart, you know, and on Social Security, you can see exactly what it is. And this is like a pass-fail test. It's not like, you know, boy, I missed it by $5. Well, you failed it. Or if you made it by $5, Social Security is going to say, okay, you get credit for that year. And depending on how many years you get, once you hit 21, your offset's reduced. 30, it disappears. But
And that's right now, there's a bill, Kevin Brady, the senator from Texas has, or is he a senator? I think
he's from Texas.
Yeah.
I think he's in the House, though.
Yeah, House, that's what it was, yeah. He's a House chairman now, right?
Could, yeah.
Of the Ways and Means Committee. Anyway, they've got a bill in right now to increase the amount you get. So you won't lose as much for being a public employee, because Texas is in the same boat we are, and a few states are. So we don't know if that'll come through or not, but if it does, it's going to change this whole thing. The formulas may change, and everything may change. We won't know till it does. So right now, what he's saying is law, but that could change this year.
And the other thing about Social Security, too, sometimes people come up to me and say, well, I have 17 years of substantial earning years. I'm 60 now. Maybe I should just retire from here and get a couple more substantial earning years. Again, back to me being a math guy, I think the math says that you're going to do much better off with us accumulating, you know, having a few more birthdays, accumulating more creditable service than you are, you know, with the offset. So don't let the Social Security, you know, tail wag the dog. I still think you're better off, to the extent that you're able, maximizing your benefit with us, and then worrying about Social Security later.
The benefit that you have of working another job outside is that it will the small amount you'll get in Social Security will help to offset your Medicare payments, which is huge because you get extra protections and everything else that way. So.
And that's a big thing too, is for a lot of people in the private sector, you know, if they want to retire at 60, well, at 60, Medicare's not kicking into 65. So they got to fill that gap from 60 to 65 in order to pay that insurance. And that's significant. You know, with us, if at 60 you decide it's time to go, you decide you're able to go, you can retire with us, and you can get your town will pay the insurance for those 5 years, pay their rate, so you're only paying your share of it, and then Medicare will kick in, and then you're just paying the supplement plan. It's not as bad. So then you have the Medicare and whatever Social Security you have. As I said, you're spot on that quite often that if you use that to cover the Medicare and then the supplement, because you'll get a raise when you turn 65 from us, because we're going to take out less. Rather than the full insurance benefit, now we're just taking the supplement, which is a bit cheaper.
How many hours can you work once you're retired?
Well, there's two answers to that question. It's always 960 hours in a calendar year. And that's with the Massachusetts public entity. So you can go work in the private sector and do whatever the heck you want. There are no restrictions. A lot of times it's the cops, they got to worry because they're doing details. But they can go work private security, and we don't care about that at all. We don't care about that at all. So the only thing we care about is working in the public sector for the state of Massachusetts. You can go to Rhode Island and work, City of Providence and do that. We don't care. So 960 hours in a calendar year, and then there's an income limitation. So it's what the job you're retired at is paying now in your position. So you can, if you retired 5 years ago, you might think, okay, well, there were 2% year increases, so it was whatever it was then, plus the increases, and it's that for the first year, and then less what we're paying you. So if the job's now paying 50, we're paying your retirement 30. First 12 months, you can make 20. The 960 hours is always the 960 hours. After 12 months, you can make that same delta plus $15,000. So in my scenario, first 12 months, 50 less 30 is 20. Then it's the 20 plus 15 is 35. And that's what you can make working in a Massachusetts public sector.
The other issue, too, that people often forget is that it isn't only working for the community, I believe. It's also if you're a contractor for that community, or if you can't go into business and then contract for the town of Middleborough and make $500,000 this year doing that. But the people have tried it, and they're still in court on it.
People have tried it. A lot of times, it might have been a town accountant, and then you go work for a CPA firm, and you're doing work for different towns. Well, that's going to count, even though you're not getting paid directly. Smith Jones CPA firm is paying you. It is still going to count. It should be the employer and the employee.
We have detailed costs to, the one person who takes, districts for payroll, but they're getting to 99 vouchers, or they're getting to 99 for every day.
And it's supposed to add up.
But is anybody actually tracking it in that?
And that it should be the police officer, because ultimately, in the ones we get people dropping dimes on are the police officers on detail. And it seems like that's the ones.
A lot of times it's their ex-wives or mad girlfriends, too.
Well, yeah, sometimes, depending on if they're getting part of it. But that's another part about this is divorce. What you're doing right now, it's a marital asset. And, for a lot of people, whatever you're doing, your retirement is a marital asset, depending upon, when you started, when you got married, when you potentially got divorced, and the quadro. Now, the quadro is supposed to be, very, a formula. They have this Arlington versus Mangiacotti that is supposed to be the standard beer for how quadros are determined. Well, they all refer to them, but then they all have their deviations. And people can negotiate off the quadros. And what I try and tell people, if you're going through a divorce, or if somebody you know is going through a divorce, let me read the quadro. I have some, and I get these family lawyers that come in. I don't think they know what they're doing. I certainly don't think they fully understand Massachusetts retirement law. They might understand, dividing IRAs, 401ks, but they don't really understand dividing the marital asset, which is your pension benefit. I will review them. I'll make sure at least it's, the court is going to determine it to be legal, because a judge can't tell me that I'm going to do something illegal, which would be maybe, pay a person a lump sum. I can't do that once they retire. So I'm going to determine its legality. But I'm also, in a lot of cases, if the member comes to me when it's a proposed quadro, tell you, do I think this is a good deal? Do I think you're signing a bad deal? I mean, some people, they just want to get rid of their former spouse so badly, they're willing to sign anything. And I'm going to try and step in and, be, immune to either side. I don't care. But this is what we're looking forward and try and prevent you from making a bad deal. I'll let you make a good deal. I'll let you make a fair deal, but I'll try and prevent you from making a bad deal. So if anyone is ever going through, a divorce, it's always best to see me before you sign on the dotted line and send it to the judge to make it a court order.
Can you just briefly explain what a quadro is?
It's a qualified domestic relation order. And it's different than a divorce. A lot of times people come in with a divorce decree. It's all this, and I'm seeing the separation of everything, visitation rights, well, this and that. Well, I don't really care all about that. All I care about is the quadro, qualified domestic relation order, which is division of the marital asset, which tells me, in some cases, it's going to tell the spouse has to choose the ex as the option C beneficiary. And then, but that ex, may or may not have to pay, their share of the difference between the A and the C. It might say, you can choose any option you want, and then, but that member's going to, choose, if you might choose a second wife, this happens a lot. If you choose somebody other than this person as a C beneficiary, then you're paying the difference between C and A. So there's a lot of different ways to divide this, and they're all supposed to be the same, but none of them are. But when I get them, and we're at the point where I'm, figuring out someone's calculation, I become a very literal person. I transform from being a math guide to a literal person, and I just do exactly how it's written on the quadro. And then it's it, and it's it for life too. So it's very important, and it's something too. Quite often, someone gets divorced, they never filed a quadro. 10 years later, they're visiting back with the ex again that they thought they were long and done with, and filling this out. Because otherwise, absent a quadro, I send all the money to the member.
Just a note on the post-retirement. There's a bill currently in, Representative Turney put it in, that is trying to eliminate the 960 hours and just have the difference in pay. So that's the only thing. And they're basing it on the fact that we're only a town where I come from, but the state has to compute this for all their employees. And it's not only cops, it's DPW workers, and in our case, the G&E does it. They have post-retirement. I don't know if the school department allows janitors to come back or whatever, but anybody that wants to work, say that you retire and you want to go drive the GATRA bus. So now you're going to make, what, $12 an hour maybe. So at 960 hours, that's not a lot of money. But if you can make the difference in your pay and the current pay now in your retirement, that's a good substantial amount of money. You can work more than the 960 hours if they allow it in the law. So they're trying to pass that, and it would be beneficial to current employees to support that when it goes up to the, when it gets considered to be passed. Because, like I say, we all have to pay our health insurance and everything else, and that extra $3,000 or $4,000 a year would make a difference to everyone, not just police officers. So.
In 960 hours is a lot. I mean, it comes out to like 18.75 hours a week. So if you really want to work 1,300 hours after retire, why retire? Well, stay on. Get add to your birthdays, add to credible service, and not worry about that. Again, let that be the driver. And the other thing too is another misconception that's out there is the average salary. A lot of people think it's the last 3 years. And it's okay, it's my last 3 years, whatever it is. And then they might be full-time, and all of a sudden now they're at 60, and they have a couple of grandkids coming, and they want to help out, they want to babysit the grandkids 2 days a week. But they don't really want to retire yet. But they want to, the town will let them drop down to 3 days, but they're afraid, if I drop down to 3 days, and rather than making $50,000, I'm only going to make $30,000, how's that going to affect my retirement? Well, it's not. Your average 3-year salary is whenever moment in time that happened. So that could have happened 5 years ago. It could have happened 10 years ago. It could have happened 2 years ago. But it doesn't necessarily mean it's the last 3 years. So if you have that scenario where you want to sort of semi-retire, and then, not be worried about the restrictions of 960 hours, drop down from 5 to 3, still be a member, still get credible service, still get age factor increases. If you can negotiate that with the town, more power to you. But don't worry about the fact that it is your last 3. We don't ever change. Once you've achieved your maximum free, like on the website, That's pulling the high 3 whenever in time it hit, and that will never go down. They're better. We prefer them. We certainly take walk-ins all the time. But if I have, 3 appointments in the day and someone walks in, I'm giving priority to the person with the appointment.
What's your name again?
David Sullivan. You can get something else you can find on the website. I have business cards up here I'm leaving behind. You can send me emails anytime. A lot of times with retirees, I say to them, or people, you might have a question on a Saturday. And all of us, we're all getting more gray in our hair, or not everyone, but most of us. And by Monday, we forget what the heck the question was. We knew we wanted to ask someone something about retirement, but we forgot what it is. If you have a question on a Saturday, ask me. Send me an email. You're not going to get an answer from me on Saturday. You're not going to get an answer from me till Monday. But, by then, at least you'll get the answer, and that will be a question. So that's a good way to get in touch with me, too, electronically.
I just have one more question about that, buying that service. If I got killed in a car accident tomorrow, am I waived by that?
Nope.
Well, I really should do that.
It can be to your best interest. It certainly can. I mean, do you have the money?
Yeah.
Then why not? I'm big on trying to get people not to procrastinate. If it's there, and especially, if you have deferred comp money, you can do it, it can be your best interest. Now, your wife would either get it all back, those lump sum, or if she's doing that D benefit, it would add 4 more years, and it would give her 4 more years of it. So if you have the money, there's no sense putting it off.
I have one other question that's more about the whole car accident. We were reading a few years ago that the state was trying to work on the system. Is that something that's still ongoing?
I'm going to defer right now to Mr. Thomas O'Brien.
The short answer is no. The state is always looking at the different systems that are out there. It was part of pension reform. It was really 2, I'd say 7, jokingly, because they did so many pension reforms, none of which I believe actually helped the members, they helped the systems. And there was an effort at that point in time to create a benchmark that the systems had to meet in order not to be assumed into the state system. Rest assured, not only are we outperforming that benchmark on a fairly regular basis, I don't think the state has any further interest in assuming those systems. There are a few underperforming systems that were assumed in under that legislation, but most of them are within the rubric of the state office. So we like the fact that we're local, that David and I can come out to Middleborough and answer your questions. If you need something, you can go to Portage, and you don't have to drive into Ashburn Place. So I believe the more that you can keep your systems local, the better off we are. David made a comment, and I'll just add this in. We're a very member-centric system. And actually, I'll just stand up so that I can see some people in the back. We care passionately about our members. If there's ever a decision where it's between the system, the state, and the town and our members, I can tell you we always side with our members because we believe you worked hard. We believe your pension is a very valuable asset that you have. David points out it's a marital asset. But we do our best to make sure that you get the best service you can get. So we'll fight long and hard to make sure the system is here for you as long as we can.
And there are some counties that are no longer counties that have their system, like Middlesex is now a regional system. So it operates the same way. So how many counties still exist and how many got blown up?
So the 14 counties, there are 7 still in existence, but one of them is essentially the city of Boston, Suffolk County. So there's a dispute as to whether that exists as a separate county or not. So other than that, there are 6: Dukes, Nantucket, Barnstable, Bristol, Norfolk, and Plymouth County.
David, could you take a moment and just go over your staff, because they may interface with someone other than you when they call?
Oh, well, hopefully. We are a staff of 10, and we keep busy. And you can look on our website for our staff. We're all titled, and you can kind of figure out who it is. But some people that do the payroll going to be dealing with my payroll people too. We've had recently a couple movement in with our staff. So Cindy Mullen, who used to be dealing with a lot of the payroll people for deductions, is now in charge of retirees, and Don Hanley's now doing the payroll deductions. So that we have a director of investments, Peter Manning. We have an assistant director, Chris LaFlamme, that also does a lot of the counseling. calculations. Actually, if anyone's going in disability, Chris is going to be the first one that will walk you through the process, to walk whomever through the process. Chris is very thorough. Chris dots every I, crosses every T before he moves things along. So sometimes it seems like things are going slowly, but we're going to catch anything that might be missing before we send it to PERAC, and then we got to wait 30 days, and they'll send it back to us, say, hey, you're missing something. So Chris will be the disability person, but he does a lot of member services as well. We have a fund accountant, we have a director of operations, but everyone else, what we're also trying to do is learn each other's job. So what we're trying to not do is have 10 different people on the staff that each do 10 separate things and no one knows each other's job. We're really, the past year and a half, we're trying to learn everyone else's job. So someone's away on vacation, someone gets sick, whatever, they can step in. And we have a pretty good staff right now, and I'm happy with the staff.
Question, does a retirement plan from, like, I have a Teamsters pension too, one that I do decide to cut. It doesn't affect Plymouth County?
No. No, we don't care about anything else. Like, again, the Social Security's going to care about, they might care about, different things, but we just care about ultimately in time, your age of retirement, creditable service, and your average salary. And we're not, you could have hit a lottery ticket for, $10 million. We're not going to hold that against you. You're going to get what's due to you.
I actually just have one question about the post-retirement work in the public sector. It was the percentage of income difference before your retirement to what you're receiving from retirement?
Yeah, so what the job you were working, what it's paying now, in whatever that job is paying now, so you could, 10 years later, and so whatever that same job is paying then, or in case like fire and police, that could be the sergeant. We're not assuming okay, someone said, well, if I stayed in another couple of years, I would have been a captain, and that doesn't, we're not going to help you that. So whatever the job was paying when you left, less what we're paying you, and that's A, B, or C. So if you take a C, it'd be less than the A, and you can make that difference for the first 12 months. After 12 months, you can make that same difference plus $15,000.
I guess my problem is I work at Virginia and I monitor a lot of this, but I don't know what options my retirees have selected or what their payout has been, so I can't really judge if they have reached that threshold.
And again, that's maybe when you want to talk to your retiree and tell them, hey, you need to watch this yourself, so they know what they're getting. Okay. And they can figure out with the town how much the job is paying, because ultimately it's their responsibility. If they go over, it's coming out of their pension, it's not coming out of your paycheck. So ultimate responsibility is of the retiree.
The other issue too is keep in mind the G&E, you're paying them for their work post-retirement, right? They're working for you. So based on, of course, you'd have to run it through town council, but you can ask them to produce that for you, That's something that legally you might be able to. I don't know. You'd have to talk to town council, but...
And I hate to say it too, but everything we do is public record. Somebody's a bad boy and they get in trouble and the newspapers find out it's one of my retirees. They find out, hey, they file a freedom of information request with me. How much does that person make in retirement? Because it makes their story a little bit better. There's this person who was a bad boy, got arrested, is also making $52,000 a year from Plymouth County Retirement. So we are subject to public information, request, and anything that we do is we're an open book. So anyone can file a FOIA. So if you really want to know, you can ask me.
That was what I was getting at.
Yeah.
There's someone I can contact.
Yeah, no, you can.
Do the math.
Yeah.
Okay, you just have to pay, if you want to count it, you just pay back what you overpaid.
Exactly. The difference. So if you made $1,000 too much, then it's $1,000. If you work 980 hours, then it's 20 hours, whatever the rate was, you got to pay back.
And that's it.
A lot of those paybacks?
We don't. We don't. A lot of people monitor it. I mean, they don't like working for free. So when we counsel people at retirement, we explain to them. But again, I mean, a lot of people, when they retire, they want to retire. They don't want to go back to work for the town. We quote 6 to 8 weeks. And that's a function of two different things. I mean, one, it's really when we got that last payroll. You know, and we're only receiving now from the towns, you know, checks once a month. We're about ready to start asking all our employers to send us ACH payments so that when they pay their people direct deposit, they also pay us, so that if a town that pays people every week, they can start paying us every week rather than us waiting for the end of the month. Or if they pay every 2 weeks, they will pay us every 2 weeks when they pay the employees, so that we can move things a lot quicker. But the way it is now, if somebody worked yesterday was the last day, October 31st, more than likely, they're gonna get a paycheck in November. So right now, I have to wait for all of November information to come in, and it averages around the 20th of a month. So, you know, it's usually around November 20th or so, 15th, and things are getting better since we went to this PTG, a portal system as well, that, you know, someone retires at the end of the month is usually close to 8 weeks. Somebody retires like, you know, November 15th, and their last check was November, you know, 22nd, it's much better shot for me to get their money, you know, get them their first check in 6 weeks. Sometimes it depends on the towns. You guys are not all created equal. You know, some towns, you know, we get, you know, quickly, we get everything's correct. Sometimes we have questions, sometimes we have to wait. The other retiree suffers because we can't do anything until we have the information, the final information. No matter what, when you get your first check, it goes back to your date of retirement. So for a lot of people, we paid in September, we were getting, you know, we were paying them, you know, 21 days. We were paying them, you know, 20 days. We were paying them 15 days. And then yesterday, they got their first full check for October. So in the first one usually is a check, and then the second one goes direct deposit. But we always quote 6 to 8 weeks. We're getting better. I think the towns are getting better. And we have a few plans in place to even make it even that much more efficient. They get it back to the date of retirement. They get, no matter what, someone will get paid back to the date of retirement. But we've been doing pretty well recently that the first check is less than a full month's check. But I say that, now you go back to June 30th, there's two things I want to talk about June 30th. June 30th is a different game because of all the school employees usually leave. So June 30th is our mailman's Christmas. It's our busiest time for retirement. We just have tons of June 30th. So then that kind of slows things down because, you know, that stack of calculations I have to do is a lot better than this month, which isn't as bad. The other thing about June 30th I want to talk about is cost of living adjustment. Sometimes people come in to me and say, okay, well, I'm going to retire on, you know, July 4th. You know, get ready for the summer and go up July 4th. And this is the other advantage about coming in a year earlier, is that when we do COLAs, it's always based on who was retired on June 30th. So our next COLA that I'm going to assume we're going to vote in, but it's something that is you know, still has to be done. It's not automatic, although historically it can be, you know, counted on. It will be, you know, we'll pay people, anyone that was retired on June 30th, 2017 will get a COLA in July 2018. Now, if they waited to this July 3rd and they went then, and July 3rd, 17, they're not going to get their first COLA until July of 2019. So if it doesn't matter to people, a lot of times I counsel them, get out in June. You know, that right now, I mean, it was 3% of the first 14,000, which is $35 a month, excuse me, $420 a year. For the rest of your life, it's pretty good. But for somebody that was, the birthday was July 4th, and now they're getting that extra age factor, then I'm saying, okay, forget the COLA, you know, take the extra year age. Just, you know, you're not going to get the COLA soon, but.
Get a huge raise. You want to stay for a couple months.
Well, some people stay too into July because they get all their vacation all at once in July. You know, other towns will just, you know, gradually give people vacation time. So for those towns, I get why people stay because they can automatically get 5 weeks, which is better than, you know, $35 a month. But, you know, at least we get people thinking about that and what their retirement date should be. But June 30th is always, you know, the day of. To be eligible for the next year's COLA, you have to be retired June 30th the year before.
So my birthday is the 14th of January, but I'd be better off to wait until the
Well, you can go to 14th. Yeah, I mean, it doesn't, for age-wise, there's no difference between January 14th and January, 31st. For credit for service, say your anniversary date was January 14th, well, you gotta work that day. Say January 14th is a Sunday. Well, then you can call it Friday, you just miss it, so you gotta work Monday. Sometimes, fire and police again, they work on Sundays, so, thankfully. So they can do that, but for a lot of us that put one people, we can hopefully get some days off, so then you have some people going back, but they might stay the whole next week because they want to finish that. A lot of my paras, their birthday could be, March, and I'm saying, okay, well, you hit this number in March 15th. Well, the paras, because they're just such good people, want to finish the school year, they want to finish something they start. I get that. They don't have to. We're not going to make you stay there, but, people do what they want for whatever. So I usually get people to go to at least a day, and then they pick maybe what's a better date. You gotta wait till January 14th. And then, well, a lot of people don't. They don't want to work the winter. Yeah.
Just keep in mind that, number one, you got a couple tools, and David, if you would, just when you go in as a new member and you haven't signed on, what is the first thing they're going to see? Are they going to have to put a social security number in and then get a password, or how does that work?
Well, no, there's the member self-service portal. I actually haven't done it in a while, but it's just entering data to set up your own account.
Yeah.
They say it's always good to set up your own account, your own password, so somebody doesn't do one for you. Someone might know your name and social, and all of a sudden set up their own account, because so if you set up your own account, you can safeguard it a little better, even if you're not using it for a long time.
The other thing is you can always call, stop down, get an appointment, and they'll walk you through your personal information, because there's no way we can take all questions about everybody's personal information today, but.
We do estimates for people all the time. And they'll come in, and usually someone comes in and tells me, all right, I want to retire, January 14th or whatever. And quite often while I'm doing that, I'm in my mind, I'm giving them two other estimates. I'm printing out two other estimates just to give them something else to think about, because I might be thinking, I might be looking in their history and seeing 2 other days that just might make a little more sense to stick around to. Sometimes it works, sometimes it doesn't, but it ultimately is your choice. But coming in, at least it allows me to, explain the A, B, and C better, what exactly it means to you. Maybe exactly when it would expire, because I say on average 10 years, but when I get somebody in, I can tell them, okay, it's going to be 10 years, 7 months, and 20 days. There's going to be nothing left in this account. I can tell you then exactly when that B factor will zero out.
On D, okay, so my son's 40, and I essentially, and I checked over in that 9%. So then, what sort of percentage does he get, or
We would retire you the day of passing. We would do the 2 factors, so be your age then, his age at the day of passing, and whatever it is, whatever the C would be that day would be it. So again, it's like the C without the 2/3 reduction. So on both of your ages. So it was though as you took the C benefit that day yourself. It's what the member would have gotten that day if they retired that day, the C benefit, but then the beneficiary gets it without the 2/3 reduction. But
they have the option to take it until?
if you name them a D, they don't. The only one that would have the option is a spouse that was not named. But again, I think I'm probably pretty good about it, showing the math, and that seldom, makes sense, if ever. That's it. I thank everyone for coming. Hope you learned something.
Everybody, thank you, David. Very nice. Hang on one second, please. I just wanted to mention that this was sponsored by the Middleborough Retirees Insurance Group at mrig.org. When you do retire, if you're a Middleborough retiree, you get invited. Actually, you get your first year as a free member. And we support the insurance part of this that you'll be paying once you retire. We also support retirees in any way that we can help out. Okay, and there's a group of us. We have an annual meeting, and you're all welcome to come to that meeting. It's usually in May. So before you leave, you also have refreshments up here, and you can please open up the apple cider. Nobody's touched it, but thank you guys again. It's a nice job. We're an outlet. You can come to us. We'll point you in the right direction. So we do this every couple of years. We sponsor this for everyone that's not retired yet. And anyone that is going to retire from Middleborough for the first year, we're giving you the first year membership is free. So once you retire, we lock you in as a member, and you'll get newsletters and such. And of course, you can go to the annual. In May, we have an annual meeting that everyone, not everyone, a lot of people that still live in the area come and get together, mostly as a social event, but also to get a update on any legislation that affects retirees or health insurance. So that's what we do, and we're sponsoring this, and we're lucky to have the new executive director of Plymouth County Retirement, David Sullivan, come in to give you guys an overview of what retirement is like and answer all your questions. So again, we'll give it about two minutes or so. If you want to jump up now, do something, drink or something quickly, or use the bathroom, do so now, and maybe a minute or so, David will start. Any questions of me at this time? Okay. If everybody's ready, we can start. Yes, so David.
Yeah, I mean,
Yes.
I'm not that new. I know maybe I'm new to Charlie, but I mean, I'm almost wrapping up my second year at Plymouth County, and I'm past 34 years in this retirement game in total, so there's pretty much not much I haven't seen. But life at Plymouth County has been a little bit different. As I said, I tell my wife sometimes, it's like a box of chocolates. You never know what's going to walk in the door on any given day. And that's because everyone has their own story. Everyone has their own situation. To Charlie's point, that's why we, if you have questions, bring them up. We have the morning session as well. It's very interactive. It's very good because, your question, might be someone else's, and something pertains to you, maybe a little twist. So it's good. It's a good way for us to do it. As a milestone, last week on Friday, the system finally reached $1 billion in investment assets. So we're all very proud of that because when I came on board, we were on 800,000. I'm not going to take credit for that. We have a staff, a director of investments, and the retirement board. We're taking the whole investment part of it very seriously. So the $1 billion mark was a nice goal for us. That was last week. Unfortunately, yesterday was the last business day of the month. Charlie wanted a check along with 4,000 other retirees, and it was about $9 million under. So now we're back under $1 billion, but hopefully the market will get us back up there so we can sustain being able to pay retirees currently right now about $9 million a month and still keep the investment portfolio growing. Everyone's working towards superannuation. As I said too, that the story is everyone, that's the superannuation retirement allowance, which is what we all want. Disability is there for people. Sometimes it's necessary. It's important for them, but I think in everyone's own, get the superannuation, especially the group 4 people. It's a little easier to get to the 80%. Probably a better percentage of people get to 80% just because of the age factor being a little bit different. But the superannuation now, is everyone here probably? I'm looking at a lot of gray hairs that probably started before April 2nd, 2012. Is that it? Do we have anyone afterward? So it's different rules. I mean, the legislature's changed the rules a lot of times. Everyone always gets grandfathered in. Way back when, you only had to pay 5% of your contributions. But then they made a change to 7%, and everyone that was at 5 got to keep their 5. Then it became 7 plus 2, then it became 8 plus 2, then it's 9 plus 2. And then April 2nd, 2012 was a big game change with pension reform, and things changed significantly. Then it's still a superannuation. It's still the same 3 factors, which is age of retirement. But now, for fire and police, that what was 55 was the max age, now it's the new max age. Rather than a 5-year A 3-year average salary, we do it based on, now it's 5 years. And credible service is still credible service. But that's what the superannuation retirement goes to, and that's that calculation. There is disability, but with the disability, a lot of times, look at people come in, some of the younger guys, and they want to talk about disability. Sometimes we'll talk them out of it on the way out. You know, it's just not that. It's not the best thing in the world, because there are other income restrictions that you're going to face the rest of your life. So some people think they can get the disability. Then we had this lady earlier that she was going to go back to school, become a teacher, and go to teach high school and have this new career. Well, unfortunately, you can't. You're going to be restricted to how much you can work in the outside world. But if you just get a superannuation retirement allowance, the only restrictions you're going to have there is what you work in the public sector. So for a lot of the police, it's the detail work. But it's only working what you would do with a Massachusetts-based public system. We've had people that will go up to, I have a guy recently retired, went up to New Hampshire, became a police officer up there. I know another police officer went down to Fort Myers. He's a police officer down there. So you can do that without restrictions with the superannuation retirement allowance. There's also something called the termination retirement allowance that is available only to people that were members as of prior to April 2nd, 2012. And that is if you have 20 years on the job. At 20 years on the job and your position gets abolished or you're relieved of your duties without moral turpitude on your part, then you get a termination allowance is a third of the average salary plus your annuity. So that's not a bad deal either for some people that have 20 years and just something isn't working out, and just this isn't working out. Moral turpitude is it's subjective. Exactly what is that, but it's put in place that they can in effect they might have been able, they were going to fire you anyway, but it's you're going to get more than you would have been to bring the superannuation allowance. So there's that. Then it's at retirement we have the options A, B, and C. So when you're getting ready to retire, it's A, B, and C. A lot of times people come into me and will say, what does everyone do? Well, what everyone does isn't necessarily going to be what you should do. Everyone's going to have their own personal history, their own personal situation, and what's best for them. Option A is the full amount. If you're ever going to get 80%, and 80% of your high 3-year average salary, you're only going to get it by taking option A. And that's all about you benefit. That's going to last your life for the rest of your life is option A. And it's the full amount. Option B, you get a little bit less. And option B is what you're doing there is you're protecting the annuity. You put in over time, you're going to get a statement from us once a year. Maybe you have $100,000 in your account, which is your deductions plus the interest, and it basically protects against that. That generally, especially for Group 4 people, is going to expire in about 13 years or so. That's what we're going to guess that the actuary is going to, depending upon your age of retirement, the actuary is going to say the average person at this age is going to live, this many more years. And say it's just average of 13. So say you put in $130,000 in your account during your career, you retire. Now you're going to get about 1 to 2% less amount. So you're not getting the 80, you're getting down to 78, but you're protecting that annuity. And every month we're going to pay you part annuity portion, part pension portion, and you're just going to reduce your balance by that amount. So in my easy scenario, it's the side of 130, 13 years after, it's coming down $10,000 a year. So after 13 years, you've lived through that, you've collected retirement. There's nothing left in that annuity. So you're not protecting anything anymore. The only thing you've done is you've outlived the annuity, which is the actuaries, which is a good thing. The bad thing is you've given up maybe $75 a month to protect against that. But some people, something happens to them, or they don't have a C beneficiary, and they're going to want to, don't want the system keeping their money, they choose B for that sense, because if you pass away after a couple of years, rather than your beneficiary or beneficiaries getting $110,000, the system will keep all the money. What a lot of people choose, or people who are married, have a spouse, is option C. And there's a double lifetime benefit. And that way it's going to be reduced as well, but the reduction there is based on both your ages, so both your half ages, of the count half birthdays there. So depending on your age plus a half, your spouse's or other named beneficiary, you're gonna get that much less. So that could be about 10 to 12% less a year. But it's a double lifetime benefit. So if you pass first and you have a surviving spouse or a surviving beneficiary, then that person would then, at that time, receive 2/3 of what you were getting for each and every month for the rest of their life. If the spouse doesn't survive you, it pops up to option A at that moment. So, you know, if the spouse goes first, then you get what you would have on your option A.
So under option C, you can leave it to your child, and your child would collect 2/3 of your
Yep.
benefit till their death?
An eligible option C beneficiary is an immediate family member. So parent, sibling, spouse, child, or ex-spouse. You can actually choose an ex-spouse as a C beneficiary. That's it. But there are people that do. They'll name the child a C beneficiary. Now, in my scenario before, I talk about, because a lot of times people who choose this are about the same age. So the haircut, so to speak, if it's 10 to 12%, for two people, it might be in about 60 years old each. If you're 60 and your child's 33, that haircut's going to be a lot more. Because now the actuaries, basically what they do is they're projecting that no matter which option you choose, you're going to collect the same amount over time. Or they're guessing just based on averages. So under an option A, they're figuring, okay, this person's going to collect this many years, will ultimately get this kind of benefit. Now under an option C, they're going to take less. So they're still thinking you're probably going to pass away, eventually, but when you pass away at the same time, now you've gone that much less. And then the beneficiary is going to catch the difference during the course of their life. If it was, a spouse about the same age, they realize, okay, it's probably not going to last as much. That's why the haircut, what you're getting up front is more. But when you're choosing a child, they're really playing the math. They're saying you're going to get, really that beneficiary is probably not living. The pop-up factor is almost, it exists, but it's probably unlikely to happen. So they take even that much more, figuring that the beneficiary will get something for the rest of their life.
Now, question regarding the option C. If you take option C and it reduces your amount by 10%, say, is the 60% that just your spouse gets or your beneficiary gets based on the reduced amount, or is it based on the total retirement you would have gotten?
It's still based on what you're getting. So it's whatever your rate is at the time you're retiring. Now, choosing a child, you're all going to get less than choosing somebody that's older than you. If your spouse was older than you, then the reduction is even less than there, because now they're saying the math there is maybe this person isn't going to collect. So the 2/3 reduction is ultimately based on what you're getting at the time of your passing.
At the option you pick.
At the option you chose. And then whatever that is, we're hoping that there's going to be lots of cost of living adjustments in there. So, when we give you the chart, the estimate, it's going to say, okay, you might be making $6,000 when you retire per month. The C beneficiary we put there is $4,000, but hopefully you're alive for 15, 20, 25 years, and there's a lot of cost of living adjustments there. So that $6,000 at retirement becomes $7,200 over time, becomes $8,000 over time, just depending on how long you live. Now, if your beneficiary, the spouse, child, whoever, passes before you, then it pops up to option A, and then you get the full benefit at that time and for the rest of your life, because there's no change in that beneficiary. No matter what, you can't change your option. When you retire, you can choose A, B, and C. You can't change that option, no matter what. If you can't come in outside of 120-day windows. You might come in to me and say, okay, I know my last day. Coming in March, and the last day is going to be June 30th. I know it. I said, okay, that's good. You have up until 5 o'clock in the day of time to change your mind. Sometimes, more often than you might think, employers incentivize the people to stay once they've given notice. So you would give me your paperwork to me, and if it hadn't hit that date, 5 o'clock yet, we can pull it back and start all over and change it. So there's that. You can't change the option. If you name a C beneficiary once you pass, you can't change that C beneficiary either. So it's going to be that person for the rest of your life. If you choose an option B beneficiary, say you chose your spouse as a B beneficiary, now the spouse passes. It's not popping back up to option A. Now you have an empty beneficiary. You can change the beneficiary. You can name somebody else there. You can put all children equal shares. You can choose one person. You can choose a charity. You We've had people before that have chosen 2 churches as charities as their option B beneficiaries, so that can be done. You can't name a church a C beneficiary, but you can name, a charity a B. But you just can't change the option at all once you've retired.
Unless you're a C and that person dies.
You're not changing the option. All you're doing there is the benefit is changing for you. But the option still remains C, and now with no chance of a surviving beneficiary.
I don't think, once you make a decision, A, B, or C, you can never change it, the person that retires.
Correct.
Okay, thank you.
Yeah, and in some cases too, I mean, we have people that chose option C, naming their spouse, and then the spouse goes off and finds a, shiny new toy, and is no longer a spouse. Well, that spouse is still the option C beneficiary no matter what. And it kind of stinks, but that's the way it is. Now, the other thing I like to talk about is option D. I think it's probably the most underutilized option out there in Massachusetts retirement. It's just really important. I personally think everyone should have an option D beneficiary. But when I talk about A, B, and C, that's when you retire. Option D is when you're still an active member, which I believe probably everyone here is an active employee. Option D is basically, it's a different beneficiary selection. And in my case, I'll explain the example, is a contingency beneficiary. Option D is the same thing as C. You need an eligible person, which is an immediate family member. It can be parent, sibling, child, spouse. You're choosing the D. Now, if nobody has chosen a D, and you've named beneficiaries, and you pass, more than likely, the entire amount of what you put in the account goes back to your named beneficiary in one check. If you've been married 1 year, working for 2 years, your spouse, we have an eligible spouse, where the spouse is legally married, living together, and it isn't distinctions. I'm sure everyone knows somebody that's married and not living together. But if you haven't chosen an option D beneficiary and you have an eligible spouse, the spouse can go basically in and declare themselves an option D beneficiary. So they can go in and say, okay, I'm going to be the option D. Rather than taking the lump sum then, what you get is as though you chose option C and retired that day that you passed. So you're out there, you named the D beneficiary, you passed away, and it will retire you that day. Use the age factor or the member or the survivor, and you give that person as though they retired that day, and then pay the survivor the amount you would have paid the member that day. So there's no 2/3 reduction. That's the spouse can only do that. If you name a child as an option D, then they're going to get that too. They're going to get that amount each and every month for the rest of their life. Now, it's easy if you only have one child, is to name a child as the D beneficiary because, there's nothing there. You can name the child the D beneficiary, and then something happens to just you and the spouse is still there, the spouse can go back in, just like before, even though it wasn't named option D beneficiary, drop the trump card and say, I'm taking this. So that's what I did. I have 3 children, and I told my wife, okay, here's what I'm doing. We're going on a trip. We're taking a plane ride together. I said, I'm naming our son the option D beneficiary. If something happens to me later on, I'm not acing you out. I'm not trying to say, you're not getting anything over time. I'm not trying to screw you by naming. If something happens to me and you go down to retirement and say, okay, I'm ready to collect on David's retirement, whoa, you named my son the benefit? Why would you have done that? Well, I did that as a contingency factor. So if something happened to both of us, then he would get a check each and every month for the rest of his life. And basically then I told him, I said, okay, I'm not picking you because you're my favorite. It's just at this stage of the world, I trust you to do the right thing, and you have 2 sisters, and to share this with your sisters. So I basically explained, and I told my 2 sisters too, to make sure he does this in case it happens, is divide it into 4 buckets. 1 bucket for yourself, 1 bucket for each of your sisters, and 1 bucket for Uncle Sam, because you're still going to have to pay federal taxes on this. So the 2 sisters, but because we're in the retirement system, we pay people, retirees, whether the survivors or regular retirees, we send a 1099. Ours at the end of the year just goes to 1 person. We can't split that in 3. We can't name 3 beneficiaries. But then I said, but then still, that's the case. The spouse can still drop the trump card, which is why I really call it a good contingency beneficiary. Because Because say you named your wife as the beneficiary and you get in that car accident, the drunk driving Friday night, you're on a date, wipes you both out. Well, what do we do with the money? You know, at this stage, it's going to go to the estate, it's going to go to probate, it's going to take time. If you have a named beneficiary, there's something we can do about it. Also, to that point, when you retire and you're choosing a C, and we're going to say, okay, name your beneficiary. If you name, say, the spouse as a C beneficiary, well, what happens in time is eventually there's going to be a second to die, because when you choose an option C, it's a double lifetime benefit. If the member dies first, we pay the spouse and for the rest of their life. If the spouse or the survivor dies first, we pop up to option A, that person then gets their check for the rest of the life. But we're going to ask you for another beneficiary anyway, because in time, there's probably going to be somebody else that's going to be owed some money. Somebody dies, you know, the 15th of November. We pay the last business day of every month of the month just like. So we paid yesterday for October. November 30th, we'll pay for November. But if they pass away the 15th, we're going to owe somebody 15 days because we pay in arrears. So if you're already popped up to option A, who do we pick there? So we're going to ask you to name another beneficiary, or in that case, you know, most people do like all children equal shares. But you can do whatever you want. But ultimately, in time, even though you might name your spouse a beneficiary, we want another beneficiary there as well. So that's all part of the contingency beneficiary thing. I don't know if anyone has any questions on D. I know it's a lot, but I really think the math of it is great.
So then are you saying that active employees, the new people who are just being hired, that they should be going to the retirement board and filling out paperwork on an option D?
I think everyone should, not just new people. It's probably more important to people that have been there because there are service requirements. So everyone probably in this room has met those service requirements. That I think everyone should check the beneficiaries. I had somebody in my office a couple months ago, and you know, he's looking at who's my beneficiary. Sally Jones. He's like, oh my God, I married Janet Smith 2 years ago. I can't have Sally on the beneficiary. But people don't do that. They enter the force young and they're not thinking about retirement. They're not thinking about anything else.
Just a note on that too, if you look up there, he has a member self-service. And you can go in there and put in your first name, last name, date of birth, last four of your social, and you can sign up at any time during your career, and you can see your beneficiaries. You can, I believe you can change them there.
We need the document.
Yep.
We're not going to let you change it online.
Okay.
Because we want the documents. Because say you changed it, we want actual proof and a signature and a witness that all of a sudden it got changed for some reason, because otherwise then the original person, it protects us.
Okay, so you can go in and check your option D beneficiaries, whatever you have, and then go from there. But it's a good reference piece to start from. Plus, you brought up something last session, that once you go and sign in and give yourself a password, it's secured. Somebody else that knows your social security number, date of birth, can't go in and grab it on you. So it's a good thing to go in, have all your employees go in, and just sign up and get a password, secure the password somewhere so you lock your account.
What are the service requirements for option D?
Well, immediate family member. So it's just like the C. Now, with the Trump thing, is married a year, 2 years of service, then the spouse can go in and absent an option D being, declared, the spouse in that case can do it themselves. Last year, right around this time last year, one a little earlier, firefighter was up on the roof cleaning leaves. He fell off and he passed. He was able to get the D beneficiary. She wasn't getting a lot of money because the whole math of it's still then age of retirement, credit of a service average salary, but there's a $500 minimum. The board voted, it was a local option to say anyone in this option D will give them at least a $500 minimum. Not a bad deal. I mean, it's an awful situation for her, but at least she's getting $500 a month, almost $6,000 for the rest of her life. We had another young person in a different town. He was a DPW worker. He was doing a side job at night. He had a bad accident. He died away. Same thing. Wife was able to go in and declare this on her own. I think, again, the big benefit of the D, though, is just the contingency factor of what something might happen. If something happens to both at the same time. So it's an awful situation for the person left behind, but at least there's some, financial support from Plymouth County Retirement that they will receive.
have a question on option C. I took option C, and my wife is listed as a beneficiary, but if, I've only been out about a year. If something should happen to both my wife and I, we're on a trip, there's no other beneficiary.
Yeah, there's no other beneficiary.
Okay, that's what I found out after
Yeah.
I did the paperwork.
Yeah, but I mean, there's only so many ways you can, you know, you probably, I'm sure you still chose the right option. You know, and if you're looking at that, I mean, if you know you're gonna die in 2 years, yeah, maybe your name be someone else, but how are you gonna predict that? How are you gonna live your life that way, expecting it? So, I'm sure you still chose the right option. Yeah, she is. She is protected. Again, the option C is based on, you know, both your ages, so that's what's important. The other thing we talked about briefly was, you know, you choose a C and something happens in your marriage. And something important is everyone's retirement is a marital asset. And the Court of Massachusetts is going to look at what you're earning in retirement as a marital asset. And basically, they talk about the marital portion, and the marital portion is basically the amount of time you were married over your career. So if you were married 16 years, you end up working to 32, then more than likely the court's going to say, okay, well, it was 50% of the time you're married, you know, in a divorce situation, that the other spouse would be entitled to 50% of that, so that the other spouse would get 25% of the marital portion of the retirement. But I deal with quadros quite often, unfortunately, but, you know, and they're coming in and all sorts of different family lawyers, and they're all written a little bit different. And one of the things I try and tell people, if you're gonna, you know, go through a divorce, or if you have somebody else that you know to, before you sign anything, come see me. First off, I like to see him anyway, because before the judge signs off, I want to make sure the judge is ordering me to do something that I can legally do. Every once in a while, someone tries to get the judge to do something that I can't legally do. So I'm not going to, even though I might have a court order telling me to do something, if it's against Chapter 32, a judge can't make me do something illegal, and I'm not going to do it. But there are so many different ways to divide the quadro that, you know, it's important, I think, to talk to me. Because I'll review it, and a lot of times people are getting divorced, they just want to just put the whole spouse out of their mind for good, and they're willing to sign anything. But that's going to something that's going to affect you the rest of your life and your whole retirement. So don't do that. Come see me. As I said, I'll let you make a good deal. I'll let you make a fair deal. But most importantly, I'll prevent you from making a bad deal. And I've seen some bad deals out there. And so, you know, that's it. And sometimes I think that the family lawyers are out there, I'm not sure, you know, they're just trying to push through, get things done, and, you know, charge their fees. And at the end of the day, I'm looking at it. I can't tell if they're working for the member or the spouse, that this quadro is so bad. So that's something I think is important there. I talked about us being a $1 billion system, and that's good. But at the end of the day, just like what you might have in your account, it doesn't really matter to your retirement. But what it does matter to is the fact that we are a healthy system. And, you know, every year, you know, I think, you know, historically, going back for a really long time, the Plymouth County Retirement Board has granted a COLA. The last one was 3% on a $14,000 base. So what that meant for everybody this July was $420 a year, $35 a week. Not bad. I think as the system, you know, gets towards being fully funded, we become a $1 billion system, maybe a $1.5 billion system. Hopefully, long before that, we raise the base. You know, there's plenty of systems out there. The base is $16,000, it's $18,000. At least me next, I would like to at least get it up to $15,000. But I think the healthier the system we are, you know, the easier it is within the member units to increase the base. The retirement board on their own can grant the COLA, but they can't grant the base without all the member units also voting in the affirmative.
What is that, how is that done, David? Do they usually have a meeting and they all get up and vote, or they talk about it? Or?
Well, we will. We have to post it for 30 days in case anyone wants to show up and speak against it. And trust me, there are some finance members in some towns in Plymouth County that, you know, don't ever want to give any COLA. You know, they want everyone's insurance rate to be the maximum that the towns pay the less, so there is some support, but, you know, there's plenty of people out there that don't like public employees. I mean, that's just the way it is, so we're going to be fighting that battle always. But, you know, we'll post it for 30 days. Last year, nobody showed up, and the board voted in affirmative. I think if we ever, you know, or when we decide to try and raise the base again, you know, there will be people that show up, but, you know, we'll see. I think right now we have a better story going over $1 billion, and there has been talk about right now, maybe this is a good time to do it. You know, we dropped the liability, the unfunded funding schedule from 2031 to 2029, which is also important for cities and towns. I had someone call me up not too long ago and said, hey, David, okay, my town spends $3 million a year for pension appropriation. The question was, how much of that goes to the liability? Which is like anything on your credit card bill. How much am I paying this off? How much is it interest? I said, well, it's a little over 90%. So he goes, you mean to tell me that if I'm paying $3 million in pension appropriation now, when this clears up, when we get fully funded in 2029, or hopefully maybe it's 2027, I'd only have to pay $300,000 in this town. I said, yeah, that's right. So that's a big number too. So in the state, you know, their funding schedule's out to 2040. And the state allows people to go out to 2040. Plymouth County, we're trying to get that number down. We're trying to get fully funded, and we'll help out the towns. And then I think in turn it also helps membership.
Just while we're getting a pause here, I just wanted to let you know that I had some books available for everyone at one point, and these are given out by PERAC, which is the Public Retirees and Retirement Administration Commission in Boston. They were the overseers of all the retirement systems. And Dave has some of these down at his office also, a limited amount. They only gave me 12 of them. There's 5 different flavors, okay, based on, this is a survivor benefit one, prior to 2012. So if you started your career before 2012 and a survivor wants information, they want this book. So the light blue one is the one for superannuation retirees, and there's one for disability retirees. Again, I don't have copies to give everyone, but PERAC is on the web. All this is online, and this is a very good resource if you have questions other than, obviously, the best resource is Plymouth County Retirement. But, so just to make you aware that that is out there, it's at PERAC's website. I think you have a link.
We have a link on it as well, but I think the most important book in there is one that talks about disability. So if you're coming up to a disability, you know, to really read up on that and see what's going to be required of you. It's not a quick process. It's a process that takes time. There's going to be a lot of steps that need to be met, but, you know, if something's going on that you really want to... But it is all online. You can come down and see me. If someone comes down and is thinking about disability, we're going to counsel you. We're going to ask, you know, get you to ask yourself some serious, you know, questions, really, you know, decide this out and decide what to do. But there's a lot of people that come down with disability. It's pretty cut and dry. You know, we know they're going, and that's just the way it's going to be. You know, there's also for Group 4, there's presumption. You know, there's the heart law. You know, if you get a heart attack, it's going to presume that it happened on the job, assuming your pre-employment physical was good. If you're a firefighter, currently right now, you know, if you get cancer after you're retired, within 5 years, you can come back and have a look back and say that, you know, you can get the disability on that. There's also legislation out there to increase that age, so it's not 5 years after retirement, but it's after maximum retirement age. We'll see what happens with that. But that is something that if you're thinking about it before you even come down, you might want to look online and just sort of see what the process is.
Do you have a ballpark number of how many full-time retirees you have in your
I don't have average age, but we're over 4,000 retirees. I could get the average age because we just did an actuarial study on January 1st, 2017, and it talks to that. But I'm not sure what the average age is right now.
Is that happening on the website?
The actual report is. We posted our actual report on the website. We're trying to be transparent that everything we do, we're trying to, you know, post on. We're posting the audit. We're posting quarterly investment reports from our investment consultant. We're putting the actuarial studies out there. We're trying to put as much on there as possible Some of it's selfish reasons, so that I don't have all these people calling me asking for information. We can direct them to the web, especially the financial press, who's always looking at our investments, wanting to basically, mirror what our managers are doing, and going from there. So if I can just point them to the website, it just saves me some time.
Everybody knows the website. It's PCR-
MA.
MA.org. So it's PCR, Plymouth County Retirement, -MA from Massachusetts, .org. Very good website.
And I think the other thing to remember for everybody is, the board itself is a very member-centric board. We take member services extremely important at Plymouth County Retirement with a staff of 10. Member services is really important to us, and we work for membership. We don't work for the cities and towns. We don't work for your employer. So when you come in to talk to us, we're going to give you advice or counsel you on what's best for you, without regard to what's best for the town, because that's who we work for. We work for the membership, and I think that's important too. And if anyone else has any other questions, anything might be.
No other questions?
Well, I don't know if you can speak to this, but what about for those of us as we approach 65 and need to get on Medicare? What must we do as municipal employees? Some of us don't have medics taken out of our checks. The newer kids do.
Depends when it started. Yeah, was it probably 1985?
We're from 85.
So it might have been, maybe it was 86, but if you had continuous employment with, with the same employer, then you never had to get subject to Medicare or pay that Medicare tax. But if you could have gone from a job on Friday, in Carver to, Monday in Kingston, well, that would have been not considered continuous service as far as Medicare is concerned. But with that, prior to turning 65, within 3 months of turning 65, you're going to get on to Social Security and sign up for Medicare.
So, for instance, and Corey, no offense, I'm going to throw you under the bus. Corey started in 1984 with Credible Service. He has always worked here. He's never had another job. So he doesn't really, I don't believe Corey has his quarters in. So what's going to happen to him in a couple of years when he turns 65?
He's still paying insurance. The town has, you're probably better off on this than me, but the town has an option for those people that aren't Medicare eligible. And sometimes, like if you're married and you might have it, but your spouse might not, there's plans for that too.
The whole row of us are single.
Yeah.
Well, the situation is that you're going to be on the active employees insurance. Now, just if I take a second, I don't know how many are non-town employees, but it doesn't really matter. Actually, any municipal employee this pertains to, but there's a bill in right now that's going to adjust your insurance, not to do with retirement, to do with health insurance for retirees. And the bill is set up so that anyone that's currently working will be grandfathered in, and you will retire at whatever contribution ratio you're at when you retire. That'll be for the rest of your life. They won't be able to change that. So if you're at 2080 for HMO, when you retire, you'll be that way for the rest of your life. The town won't have the power to change that. Now, to get that, this bill is not passed yet. It's right now in the Ways and Means Committee. It's gone through Public Service Committee already. But if that goes through, then new employees will be subject to a, just like your retirement, you'll have to be vested for insurance. So in other words, if you only work 15 years and then retire, you don't get full insurance benefits. You'll get 2/3 of the insurance benefits. So it'll be service related as to how much health insurance you get, which right now you work for 10 years and you get the full coverage for health insurance. Now that will, keep in mind, everyone currently working will be grandfathered, but the new employees will not be. So because they needed to make a change in that because insurance was getting to the point where they couldn't afford it anymore. So that's what we're giving up in order to get the guaranteed contribution ratio at the time of retirement. Okay? So that's an important thing for you all to know if you're thinking about retiring. And that will be going through Ways and Means public hearing very soon, and then it'll be up for inclusion in as a law, you know.
And ultimately, insurance is a town benefit. It's not a retirement benefit, so if something's happening in your insurance and you want to change for turning, having Medicare from, Harvard to Blue Cross, you do it through the town, your town HR department. Basically, they'll tell us, okay, for Sally Jones, take out $100 a month. Well, now she changed the plan to a higher plan. Now it's $120 a month. We take it out, we send the town a check, and that's it. But any changes you make for insurance always will go through the town, not through us.
Another point for all public safety personnel is the federal government has a provision that if you do that and have your life insurance or your health insurance or any of your, if you happen to have a long-term care insurance through the town and they directly pull it out of your retirement, up to $3,000 of that is tax exempt on your income taxes. You have to simply put in the public safety officer in your tax return, and you get a $3,000 tax break for that. But it's got to be a public safety officer, and they define that in the IRS. And it has to be taken out through the retirement system. So that's a benefit that you also have available to you. And you have to be fully retired at 80% at superannuation. You can't be 70% retired or disability retired to get that benefit. So.
And the other important thing is post-retirement working, is what can you work once you retire from us. There are 2 limits there, and the first one is 960 hours in a calendar year. And basically when I say that too, it's only within a Massachusetts public system. So you go, if you were a police officer, you want to take a job in private security, you can do that. No restrictions at all. You can work as long as you want, as many hours you want, make as much as you can. You can go work for, Providence, you can go work for Rhode Island, and do something else, but otherwise it's 960 hours. Then plus, what the job you're paying at that time, less what we're paying you for the first 12 months. But we have sometimes people come into me and they say, okay, well, I'm a sergeant, but if I stayed on another 5 years, I would have been captain. No, we don't do it that way. So it's whatever that rank position was at the time of your retirement. And then with other cost of living adjustments, we'll raise that up. So it could have been, 75,000, and then over after a couple of years, now you're at 80. Less what we're paying you, that's for the first year. After 12 months, it's that same delta plus $15,000. So you're restricted there. I mean, a lot of times it's the cops that do details that run against us the most.
Now, you said the amount they're paying you, so if you're in option C, that would be the amount at option C.
It's the amount we're paying you.
Yep.
So what the job is paying at the time, the job you left at the time, less what we're paying you for the first year, then plus the $15,000 the second year. In the 960 hours, it's not just like, Middleborough. If you can work, 400 hours in Middleborough and 600 hours in Carver, well, you're in violation. So it's all of the Massachusetts towns combined to add up to that 960 hours.
The other thing is also, and we ran into this a couple times, if you're contracting, so instance, you make a security company when you retire, and you contract with the town to do something, change their locks, or whatever it is, and you make a certain amount of money doing that, or working for anybody that's related to the state, you can only make that limit there also as a contractor. You can't be charging towns $50,000 or $100,000 for your services as a contractor once you retire.
Anything else?
What do you know about security?
I know a little about it. That thanks to Ronald Reagan, they're gonna care, what we pay you, depending upon your own personal Social Security situation. They have a chart. Once you have, you need 40 quarters or 10 years to be eligible for Social Security. If you have 21 years of what they call substantial earning years, or if you have 20 or 10 to 20, this is going to be an offset. If you have 21 to 30, it's a gradual decrease in what the offset is. If you have 30 years of substantial earning years with Social Security, then there's no offset at all. You know, a lot of times, the fire and police, you know, don't have 30 years of that and 30 years of municipal service because, you know, they started later. Or, you know, sometimes people have a private job, you know, might go work at the water sewer. He's an operator, work at the water sewer department, you know, at 55, do that for 15 years. Some of those people seem to get away with the offset sometimes. It's not so much the fire and police that you know, reach the certain thresholds, but, you know, they're going to care what we pay you, and they're going to offset it, depending upon how much they're paying you, how much we're paying you. But there's limits. They don't offset it completely, and, you know, they're the ones that have to tell you, and you have to look at your own history too, and how many substantial earning years you have.
Just a note on that also, right now, the offset is being addressed in a, not really a bill, but they want it as an add-on. And the guy that is promoting this is a Texas representative, Kevin Brady, and also Richard Neal from Massachusetts is his co-sponsor. But they want to change that offset and basically cut it in half for you because they feel it's unfair. Texas, I think Maine, Massachusetts, it's like 7 states that it's affecting their people's getting Social Security. So if that comes up, keep an eye on it and call Richard Neal's office and let him know how you feel about it. Because that would be good if they, and it's not going to be a bill, it's going to be an add-on to legislation that goes in front of President. So, and that's something that Kevin Brady, as the chairman of the Ways and Means Committee, has said that he wants to, he's not forgetting his constituents. So it wouldn't hurt to give them a call up there and say, yes, we'd like you to support this. And Richard Neal does anyway, he's a co-sponsor, but any way you have any influence, it will help. That will, by the way, that may change the offset thing and the whole thing that David talked about regarding the 30 years and 20 years. That would probably all change, but it would be to your benefit.
And the bill is not, I mean, some people collect on their spouse's Social Security. I don't think the bill addresses that, though.
No, I don't think it does. No.
Yeah, so they're doing, at one point they were trying both. At one point they were trying to eliminate the offset altogether. Now that they're working on compromises, figuring, okay, let's try for half a loaf. So it's not what they hoped for originally, but, you know, it will benefit people if it does some time pass. Anything else, or I'm here if people have questions about their own stuff later. Sometimes when you're thinking getting close to retirement, it's always best to set up an appointment, come on down. I can show you exactly, you know, what your options are, what the dollars are. We can even project into the future. Sometimes there are better days to retire than others. And people come down to my office thinking, okay, I'm retiring this day, and they leave my office choosing a different day. Because sometimes there are a little different, you know, plans for you that are better off. I mean, you're better off, I think, coming to me in a couple of years, you know, for retirement, just to understand your options, maybe, you know, focus on that day. You can't come into me before 120 days. You can file the paperwork outside of a 120-day window. So if you're going to tell me you're retiring next June 30th, you can't come into me yet and file the paperwork. I just can't take it.
David, talk a little bit about buyback, military buyback, and any other reason you'd come in earlier than 120 days, in other words, early in your career.
Well, the military buyback, if you have military service and you have your DD-214, bring it down to us, and you're going to pay 10% of your initial salary, annualized salary when you began service, and you can buy back up to 4 years of military service. So that's a good deal for people. We don't, technically, once we officially notify you, you have 180 days to begin the process of paying back that time. There's no great advantage, you know, if you're going to go out the superannuation at 80 and, you know, paying me early, because I'm not charging you interest for it, so if it's going to cost you $12,000 to buy 4 years now, it's going to cost you $12,000, you know, 25 years from now. But, you know, person earlier session brought up an excellent question. Well, he has the money, and say something did happen to him, and his wife wants to take the option D. Well, if I can add 4 years of service onto him now, his spouse will get, you know, 4 more years when we figure out the benefit there, age, service, average salary. Because if you have an untimely death as an active member, then it's too late to buy back the service, the military service. You just can't do it. So if you have the money, you know, maybe you want to do that. Maybe you don't want to stall. Maybe you do want to, bring it in. And if you have money in a deferred comp plan, you can use money from there. So you're not writing me a check with dollars that have already been taxed. You can take it out of, from them that are, tax deferred dollars. They'll roll it over directly to us, no tax effect for you. So, if you have that, dig up your DD 214. We can call the town, tell them, ask them how much it was and tell you basically what it was. We can do it informally if you aren't ready to do it just yet, or we can formally send you a letter if you think you want to, pay it off sooner than later.
Now, on the other buybacks, in other words, you work for another town, you work for the town, whatever, swimming pool, whatever it is, you've got time to buy back, you're better off to do that early because you do charge interest, is that correct?
Well, we will. Now, if you work for another town and then went from, town, say, City of Boston to Duxbury, it seemed like City of Boston and Duxbury, there's a lot of firefighters, Duxbury firefighters worked for the City of Boston for a while. A lot of them went directly from Boston to Duxbury. We transferred their account from them to us, and we added in. It's always though they never left Duxbury. The credible service, if you had 10 years in Duxbury and 20 with us, it's 30 years. When you're getting your benefit, you're going to get it as though nothing ever happened in Duxbury. We're going to pay you. We ourselves will seek out reimbursement from the other system for their 3HC, their share of your pension costs. That's something we do. It doesn't matter to you at all. But now say you worked in City of Boston, they laid you off, you were gone a couple of years, you took a refund of your account because you needed the money, and then you went to Duxbury, and now you come back and now you can buy back that time, but you're going to be paying back with interest. Now, if upon re-entering service, and I don't know how many people here have re-entered service within the past year, right? You have 1 year to buy back service upon re-entry after a refund with half actuarial interest. Our actuarial assumed rate of return for the actuaries and investment managers is 8%. So if you do that within the first year, you're only paying 4% interest. If you wait till after, a year and a day to begin the process of buying back that time you previously refunded, then we're charging you at full interest, which is 8%. So maybe not for you guys, but if somebody that comes back into service had previously bought back time before, reach out to us. When we get an application form, though, one of the questions we ask everybody, have you previously worked for another Massachusetts retirement system? If the answer is yes, then the question is, are the funds still on account? If the funds are still on account, we'll reach out to wherever you went, and they'll pay us directly, transfer your account. If you put no withdrawal, we'll try and reach out to you and say, hey, you might want to consider buying back this time. But not everyone does, because a lot of times when they took the refund, they needed the money, they kindly get back to work, they don't have this cash up, so it's not as easy. But unfortunately, after a year, the cost of the interest is a little higher.
So this question is for another person who's not here, but there was a group of us in the early 90s who went through a layoff, an involuntary separation. So myself, I went to the MBTA, which is not part of retirement. Fall River. Then we have another guy who went to Maine, and he has like 5 years service there. Never bought his time back. So this question is, of those 5 years, how does he buy that time back?
You can't buy back Maine. In this scenario, only Fall River is the one that can buy back time. MBTA is its own system, Maine's its own system. The only system that allows you to buy back out-of-state service are the teachers, because the teachers have a better union than the cops. And that's why, and they're allowed to buy back, other state service. But somebody, a police officer, one member of my system in a different state, it's not eligible to be bought back.
Other than within that first year you come back?
Well, the first year coming back, if you were eligible, like the Fall River person, it's only going to be half the interest if you took the refund.
Okay, so now speaking for me, when I was laid off, I had 6 years of service. I took my retirement out, saved my house. I came back within just over a year, and then they double dipped me to 16% retirement.
Oh, they did double deductions for you in order to buy it back.
To buy my time back.
That was a policy that was in place. In order to buy your time back, they charge you double deductions.
Yes.
Yeah.
So is that, so my question again is for that person who was in Maine, is he still eligible for double deductions to buy them 5 years back?
He can't buy back other state service. You weren't
Right.
buying back your MBTA service, you were buying back,
My time I had left, that I had drawn out. Okay, all right, I understand.
Yeah.
So those 5 years, they're lost,
for him.
but for someone who went to Fall River?
Yep. Yeah, he's, of the three scenarios, he's the only one that can buy back that time.
Okay, thank you.
And he has to buy that back, or he had to buy that back prior to a certain amount of time to get the 4%.
To get the 4%, after a year, we're gonna start charging
he's
it.
gonna
You can
pay-
still buy it back,
Right.
it's just gonna cost you a lot more money.
I transferred it back, didn't know.
If you never took a refund,
Right, I have to agree.
then it was even easier, then
You're all
there's,
set.
there's no, but there's plenty of people like you that did think, they took the refund because, not because they wanted to, because they had to.
Right, so I double dipped and.
Yeah.
Thank you.
Along that same line, if a person works for Plymouth County Retirement, but say they work in Group 1,
Mhm.
and they work in Group 1 for 2 years and then join a Group 4 department, does their time calculate over, or do they owe somehow the system money?
No, it calculates over, but the service gets calculated differently. So now they prorate your Group 1 service and your Group 4 service differently. So it's usually not that scenario, it's just a couple of years. You know, like everything else in pension reform, they do things because somebody gamed the system. So somebody might have been, 30 years at Group 1, slides into something else for the last 3 years, Group 4, and then it was like they were Group 4 their entire career.
Okay.
They changed that. So now
So-
they prorate based on service, and the calculation's more complicated, but we'll, do, the type of service times like the Group 1 age factor, then all the other service times the Group 4 age factor.
Will that significantly impact somebody's retirement? If they spend like their early 20s in a Group
If
1?
it's- no, not-
And then at 55, retire in Group 4?
It's just the people that tried to do that to slide in at the end.
The other way?
Yeah.
Thank you.
But it's happened the other way too, that I've known in my town. The fire chief went from being a fire chief to a town manager in a different town. And so it's like, what are you doing? Now you're going the other way. But still he doesn't lose the benefit though of all that time he put in. But, if they didn't change the law for somebody else, he never could have left, because he would have just, killed himself by doing this new job. It just really would have backfired on him, but it goes both ways.
Part-time employees, either part-time police, part-time fire, the maximum number of years they can buy back, or is there a formula on that? Without, no retirement taken out, so obviously they have to.
We did a supplemental reg last year which addressed membership, that, and we said, okay, you have 20 hours a week, you're eligible for membership. And for those people, if you just got 20 hours and you did that continually, you got a year for a year. We're not breaking this down, we're giving you your 20 years, we're calling that a year for a year. But some people had part-time service prior to that, or prior to becoming a member, and they shouldn't have been, maybe they worked 10 hours a week. And in their town, their job was 40 hours a week, got them, was really a full-time job. So it was a part-time job, it might have been seasonal, something else. We will allow you to buy back that time, but we're gonna prorate it. So if you're working 10 hours and 40 hours is normally it, we're basically saying, okay, if you did that for 12 months, we're only gonna give you 3 months. So we're gonna condense it to the point where it would have been a part-time job, or a real job, and give you credit for that time. But that's only if you're within a Plymouth County system. Say you're working in Falmouth doing this, and that's Barnstable County, so we're not gonna allow you to buy back that time.
Any maximum number of years, or is
No.
it just? So
It usually isn't a whole lot because of the whole part-time, but no, if you did something, and the whole maximum years would be, if you did it for that long, maybe you should have been a member all along. And there are people we look at that towns, didn't want to give them benefits and didn't make them members, and we look at people and say, hey, you were erroneously excluded. The town should have made you a member. And so we're going to let you buy that back if you were erroneously excluded, and we're not going to charge you interest on it. And this is where we do sometimes, when I say we work for the members, we work for the members because we bang heads with the towns often. And sometimes, they think that they're the ones going to decide who a member, but that's not the case, it's us. So, we're going to work what's best for the member, and if you have a history, let us look it up. We'll go get the towns, give us your history, and then make a determination on it.
Could you just explain the need to have 120 days prior to talking to you before somebody submits the paperwork? You mentioned that earlier, just a quick
It's a law.
explanation.
It's the law, so you can't come in, as I said, for June 30th and say, I'm going out June 30th now and file your paperwork. It has to be within 120 days. There's another window too on the other side, which doesn't usually happen and probably never happens with fire and police, but I had somebody came in to me on Friday. She wanted to retire as of August 11th and get paid retirement retroactive to August 11th. Well, you also have to come in within 60 days of your last day of work. If she came in, October 8th, I could have backed her up to August 11th and paid her to, August 11th. But because she came in, October, whatever it was, and she missed it, now I have to go 15 days in the future. So don't procrastinate, and seldom does it happen, but it happens enough that it drives me nuts. Don't wait till over 60 days for your last day of work to come in and file your paperwork. You can still retire, but we're just not going to pay you retroactively.
Another point too is I suggest you do get in early in the 120-day window, because sometimes, like, I had a break in service through the military, so they had to figure out my 3 years based on a convoluted amount of time on each side of that, so it got a little confusing, and they had to do it twice for me, but they did, and they did it, and it came out right, and I was paid right on time within the 8 weeks, which may not happen if you came in a week before you retire. So, so it's a good thing to have it ahead of time.
And when you finally do, it's about 6 to 8 weeks before we get you on our payroll. And a lot of times it's a factor of two things: is when in the month you retired. If you retire in the beginning of the month and you're getting paid your last check in that same month, you're probably closer to 6 weeks than 8 weeks. But like if yesterday was your last day, and you retired October 31st, but you're going to get a check in November, now I have to wait from the town for all the November payroll deductions to come in. So now you're probably going to be closer to 8 weeks. And again, not all towns are equal. Some towns get us their payroll information quicker than others. Some get it in always accurate. Others have problems, so we have to kick things back. That slows things down too. But you always get paid back to, assuming you filed within 60 days, to the date of retirement. And we always pay the last business day of the month for the month just lived. So we paid, Charlie yesterday for October, but we also took out his insurance for November. His insurance, we're making sure he's alive. They're making sure they get paid in case he isn't. So that's the way that goes too. So some people have to get used to just getting paid once a month. But that's statewide too. That's not just a Plymouth County thing.
Other than your base pay, stipends or educational incentives count towards?
Stipends can
retirement?
be. I mean, it depends. The big thing there is regular and reoccurring.
So if I get an annual for training, for having certifications, I get a stipend every year for being certified in certain things. That
sounds like regular and reoccurring to me.
Okay.
Sometimes someone doesn't get a stipend. Say they're going to work the 4th of July, or the bicentennial committee or something. They get a stipend for that. Well, that's not regular or reoccurring, but that is the two key words: regular, reoccurring. If you're not sure about it, we're supposed to have most of the contracts on time. You can point me in a thing. Sometimes the towns, again, need a little help saying, yeah, that should be pensionable. You should be taking retirement out of that.
What about the use of the vehicle? There's a question.
Vehicles are out. Yeah, thank Billy Bulger for that. Billy Bulger is the one that was throwing everything in the world in there, and his vehicle allowance, and I think he even got a pension on that, but that was specifically excluded.
Now, a question regarding, that they just brought up, one question brings another. But when you're figuring post-retirement earnings, and you look at what the current pay would be for an officer now, for instance, or a firefighter now, you figure it based on what you would have gotten with your additional benefits, like your education incentive and your...
Well,
so in other words,
in longevity, we'll add in longevity and things like that.
Okay.
So we add in everything that would have been, pensionable at the time of your retirement.
Okay.
So we'll add all that in.
At whatever rate they're making now based on their raises.
Yeah, we're just not going to give you a promotion or
No promotion.
or any kind of step raises.
Right.
Yeah. But any other, little extras that were in there that were pensionable along the way, we'll include that as well.
Okay.
said, we're there 7:30 to 5, Monday through Friday. People on appointments, I mean, we have them at 7:30 often. You know, I know sometimes people before the shift starts or gets to work, they want to see us early. We'll see at 7:30. We'll see at 5 o'clock. You know, whatever works for you. You know, when you're ready, come see us. If it's a disability question, you can see me, but I'll turn you over quickly to the Assistant Director, Chris. Chris does the disabilities. Chris is very meticulous. He's very methodical. He's going to make sure you have everything in order before we submit it, you know, to the state, because we don't want things kicked back to us. You know, so as I said, the disability process is the one that takes the most time, and it's the most involved. But you know, for some people, it's a lifesaver.
David, do you have anybody specifically for survivors to speak to right now, or is it?
I quite often, if I find out somebody has passed, I'll be the one that reach out to a survivor, you know, and, you know, as I said, when I say we're member-centric, we do everything for the members. If I find out someone's passed, I mean, usually with me, survivors take precedent. We try and let the dust settle, you know, because we don't want to reach out to people too quickly, but we want to make sure that, you know, they understand their rights and get everything that they deserve.
And if you have a situation where, I know you have a staff of, what, 8 or 10
10, we're
people?
10 total, including
10
myself.
total. If there's a question that's an understanding situation, or somebody they're working with down there that they'd like to speak with someone else or speak with you,
You can always speak to me.
Okay.
I mean, I'm always available. You know, I say to people, you can call me, leave me a message. On the website's my email. A lot of people, you know, come in our age, you know, on Saturday, they have a retirement question. And by Monday, when we're back open for business, they forgot what that question was. So if you have that question on a Saturday, send me an email. Don't expect a reply from me on a Saturday, but I will get back to you on Monday. And so that sometimes is a very efficient way of asking questions too, is via email.
Anything else? Did we answer all the questions you have at this point?
And if you think of a new question tomorrow, feel free to give me a call. If you have something on your account, you want me to check a beneficiary, you know, we triggered something, you know, give me a call, shoot me an email, and, you know, we're open for business.
Your number's on the website?
My number's on the website, my email address as well.
The only thing that I didn't notice was extensions on the website, you guys. Actually, I didn't notice your numbers specifically by name, I don't think, or extension, that's what it is.
I'll look into that. I thought they were on.
They used to be.
It used to be on.
Yeah.
I don't know if it fell off for some reason, but I'll check that.
Thank you.
All right, take care.
Thank you again, Paul. Okay, you have something, bring the refreshment with you if you want.
Group 1 people wiped them out. I brought